I want to welcome the Governor of the Central Bank and your officials. You're very welcome to the meeting, and to congratulate you on your recent appointment and to wish you well in the future. I wish to advise the witnesses that by virtue of Section 17(2)(I) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If directed by the committee to cease giving evidence in relation to a particular matter, and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you were asked to respect the parliamentary practice to the effect that, where possible, you should not criticise or make charges against any person or entity by name or such a way as to make him or her identifiable. Members are reminded of the long-standing parliamentary practice to the effect that members should not comment or criticise or make charges against a person outside the House or an official, either by name or in such a way as to make them identifiable. I want to invite Governor Lane now to make a opening statement.
Okay, thank you. Good afternoon, Chair and committee members. I welcome the opportunity to meet with you for our regular engagement, and I'm joined by Derval Rowland, Director General for Financial Conduct, and Ed Sibley, Deputy Governor for Prudential Regulation. Let me start with a brief overview of the macroeconomic outlook. Later on, we'll come back to Brexit, but in terms of the baseline forecast, we're currently projecting that the measure of underlying domestic demand, which is, I think, the best measure of what's going on in the economy, will expand by 4.3% this year and 3.9% next year. And in line with that, we're projecting unemployment to average 4.9% this year and 4.7% next year. The consequence is, in terms of wages, compensation per employee, we're expecting an increase of 3.4% this year and 3.6% next year. So in cumulative terms, around a 7% increase over the next 2 years, which is fairly significant given inflation is quite low. Now, given the recent downgrades in European and global economic forecasts and the bias to the downside in the risk assessment, we'll continue to monitor the possible implications for these forecasts if there's any further decline in the external environment. Now, if I turn to the work of the Central Bank, all that we do is guided by our mission, which is to serve the public interest by safeguarding monetary and financial stability, and by working to ensure that the financial system operates in the best interests of consumers and the wider economy. In terms of our priorities in terms of policy, our recent strategic plan for 2019 to 21 highlights strengthening consumer protection, resilience and Brexit. And I will address the issues that you listed in your invitation letter in the context of these strategic priorities. So if I take first strengthening consumer protection, this is, as indicated, a high priority for us. This is in the context of an overall strategy to enhance confidence and trust in the financial system through high quality regulation, purposeful engagement, effective gatekeeping, assertive supervision and robust enforcement. And consumer protection is embedded through all of those dimensions of how we work. To give one bank-wide example, our macroprudential mortgage measures are intended both to enhance the resilience of the financial system and protect households from excessive debt. Our work on mortgage arrears has also involved considerable collaboration and coordination across all parts of the bank, again given the importance of making sure that all angles, both the resilience angle and the consumer protection angle, are factored into our work on non-performing loans. Now, if we think about the role of the interaction of prudential supervision and consumer protection, it's essential that individual firms are resilient if consumers are to trust that deposits are safe, investments are protected, and insurance policies will pay out when a claim is due. In addition, our prudential and conduct supervisors have a shared interest in the sustainability of business models, the arrangements for governance, risk management and control, and the culture of regulated firms. So when we think about our new strategic plan, in terms of building on what is already there, which is quite extensive in terms of the framework, really the next step forward is a focus on the conduct of firms. This is essential given the wide range of misconduct scandals we've seen around the world including at home the tracker mortgage scandal. It's also reflected in terms of strategy in our supervisory approach, which is increasingly focused on conduct and cultural issues. If I provide you with an update on the tracker mortgage examination, which is now in the final stages. At the end of last month, nearly 40,000 customers have been identified as suffering unacceptable harm from these failures. The overall number is the same as at the end of December. There's been an increase in the total payout, which has increased now to 665 million. And by the end of March, we expect the accounts remaining to be paid to be about 300. In turn, of those 300, most would be paid in April. So we really are towards the end stage here. And by the way, some of the remaining numbers relate to cases where the file is there, but it's proving difficult to contact the individuals. But of course, that money will remain for them once contacted. Now, as we've supervised the tracker mortgage examination, the focus at all times has been to make sure that all groups of customers that have been affected have been identified and received remediation. As indicated, this is now largely completed, and where the remainder is, it's to make sure that any final issues affecting groups of customers are worked through and all eligible groups are included. So we expect this to conclude in the coming weeks and to issue a final report thereafter. Now, of course, when we say this examination is coming to conclusion, that's in the sense of a particular project. Of course, any further individuals or groups that emerge for whatever reason will receive the same treatment under our business as usual supervision. It's important to emphasise that in parallel to the supervision, the enforcement work on this scandal is ongoing. These are detailed and forensic investigations involving the scrutiny of thousands of documents and the conduct of interviews in order to establish the exact circumstances of the matters under investigation, including the actions of individuals and entities. If we look to the future, our culture report from last year emphasises that we think the framework would be further improved by having an individual accountability framework. This would ensure clearer lines of individual accountability within firms, as well as providing for an enhanced fitness and probity regime and a unified enforcement process. So my understanding is we'll come back to this in a separate hearing in the coming weeks. Let me turn to PCPs. This is something where we've been working on from different angles for a while. The data through the end of June 2018 show around 70,000 outstanding contracts, which amounts to about 1.2 billion in value. And it's important to note that from the end of June, by the summer, our new Central Credit Register will collect information on PCPs from all lenders that provide these loans. So our understanding of these contracts will be further enhanced when those data come online. We're also working to strengthen consumer protection in relation to licensed money lending. Last year we published a consultation paper which proposed adding certain extra measures to the code. The plan is that these new regulations will come in the second half of this year. And of course, in finalising these additional measures, we fully recognise the vulnerability and particular circumstances of the households that typically engage with licensed money lenders and the high cost of these loans. Let me now turn to the resilience topic, under which we will address the issues of capital requirements, interest rates and non-performing loans. So throughout our strategic plan, throughout the fundamentals of a national central bank is to make sure that the financial system is resilient, so that it can withstand shocks in the future and protect the wider economy from financial instability. Let me first take on the issue about capital requirements. It's important to note, and especially when we think about the risks we face now, that the capital position of banks has improved by a factor of 3 since 2007, when measured compared to risk-weighted assets. Another vulnerability is in terms of funding risk, and in contrast to what was going on in the boom, the reliance on short-term wholesale funding has declined significantly, and now the primary funding base is domestic consumer deposits. And with the decline in funding costs, it's interesting, despite recent market volatility, the funding costs facing the banks remain contained. Now, as already indicated, our strategy to improve resilience include our macroprudential measures. An important element of that are the mortgage rules, which, as indicated, have the dual role of both protecting households and banks from excessive debt, and to avoid the risk of a spiral between credit dynamics and house prices. In addition, last year we made the decision to activate the counter-cyclical capital buffer, which will come into force in July at a 1% level. Importantly, this is intended in good times to build up the capital levels in the bank, but in turn this will mean banks will be less likely to engage in a credit squeeze in the next downturn. We also have an extra measure called the OC buffer, other systemically important institutions, which basically protects against the risk of any individual bank causing problems to the system for a variety of reasons. If I turn to the issue of prevailing mortgage rates, our analysis indicates that some of the factors that need to be taken into account are historical default rates, the level of non-performing loans in portfolios today, the fact that, in contrast to other jurisdictions, the typical mortgage in Ireland has a high loan-to-value ratio, so its risk profile is higher than in a situation where more of the house purchase is funded by a down payment. The reality is the Irish market is a small scale, and fixed cost elements in banking are increasing in relative importance. For example, the cost of IT systems. We also see lower levels of mortgage switching in Ireland than in many other European markets, and there's no doubt that the limited number of banks in itself leads to concentration and less competitive pressures on pricing. If I come to the non-performing loan issue, as you know, we've been emphatic in identifying the importance of reducing non-performing loans in the banking system, since non-performing loans at excessive levels compromise the capacity of both the banks and the debtors to weather future downturns. There's been a lot of progress on this. The stock of non-performing loans is down by 79% since the peak in 2013. As you know, there are many ways to reduce non-performing loans: re-engaging with the debtor, restructuring a mortgage, a write-down, engaging through the insolvency service, loan sales, loan securitisations, and then the court process, seeking finality through the courts. Let me emphasise in terms of balance that over the years since the crisis, the primary way non-performing mortgages have been addressed has been through restructuring. The Code of Conduct on Mortgage Arrears has played a critical role in ensuring that borrowers are protected. And also within the CCMA, the mortgage arrears resolution process requires that repossession is only used as a last resort. So we have seen an ongoing decline in the number of long-term arrears cases over the last 5 years, and as I indicated, we've seen a lot of restructuring. The amount of accounts that were restructured, the total at the end of last year, was over 111,000. And these restructurings seem to be working well, where 87% are meeting the terms of their current arrangement. Now, having said that, there's many other options in terms of addressing non-performing loans. It remains the case that for a secured market to work, repossession as a last resort has to be an option. And while we have extensive protections in place for distressed borrowers, the loss of ownership risk remains. It's important, again, to remember that the scale of repossessions in Ireland has been low in an international context. And if we take the most recent year, in 2018, 877 primary homes were repossessed, 1/3 as a result of court actions, and the remainder through sale or surrender of the property. Now, we share, I think, the societal concern that these borrowers who are at risk of losing their homes are extremely vulnerable, and our focus in our supervisory work is to ensure all lenders, whether banks or non-banks, adhere to the Code of Conduct on mortgage arrears. We continue to urge all borrowers and lenders to engage and seek solutions that minimise loss of ownership. Now, having emphasised that restructuring has been the single most frequent approach to reducing non-performing loans, it's clear also that we're also seeing sales of loan portfolios to non-bank investment funds. This does have a valid role to play. I've commented before that from a national point of view, the transfer of these loan portfolios to non-banks, which are mostly owned by foreign investors, constitutes a reduction in national risk. In the event of a future downturn, the burden of those potential losses will be shared overseas. And we also, with the support of the legislation, have made sure that the statutory consumer safeguards are the same regardless of whether a loan is held by a bank or a non-bank. So, given our twin focus on resilience and consumer protection, this framework, this approach, explains why we do have grave concerns about the no consent, no sale bill. Given that the consumer protection framework from a regulatory perspective is the same whether a loan is held by a bank or a non-bank, we do not see that the bill would add any extra regulatory protection for consumers. At the same time, it would damage resilience, since the transferability of loans is a central feature in a modern financial system. In addition to restricting the ability to sell loans, please recall that the transferability of loans is also important in relation to securitisation and also in terms of collateral provision to obtain liquidity, whether liquidity from the interbank market or from the euro system, from us or from the ECB. So while these restrictions are costly even under normal conditions like today, and because of those extra costs, they would have an effect of raising interest rates, their impact is especially destabilising in a crisis environment, since the ability to restructure balance sheets and obtain liquidity is essential to resilience under crisis conditions. So while we recognise that the bill makes an exception for failing or likely to fail firms, this designation is only made once a crisis is well advanced, whereas financial stability is best maintained by ensuring that resilience-enhancing measures can be taken in a timely manner, with the strengthening of balance sheets during good times, allowing the economy and the financial system to better withstand adverse economic and financial conditions. Let me turn to resilience in the credit union sector. The Central Bank has an important role to play in making sure that the credit union movement in Ireland thrives, and our vision of a strong credit unions in safe hands underpins our mandate to make sure that each credit union protects the funds of its members, that financial stability is maintained, and that the credit union movement is in conditions of well-being. Now, when we look at the conditions in the sector, as we reported in December, we see strong reserves, sustained expansion in lending, and a continued reduction in arrears. However, there's no doubt that challenges remain for the sector, even though there is dispersion across individual unions. We see an average loan-to-asset ratio of only 28%. We see a high cost-income ratio of 74%, and a low return on assets of just 1%. Now, it's not the regulatory framework that is leading to this dispersion, and the regulatory framework does not inhibit future business model development. So overcoming these structural challenges involves the credit unions improving their competence and capability, addressing operational effectiveness, and expanding revenue both through loans and non-interest income. We view the regulatory framework as tailored and proportionate to credit unions. Given that the average loan-to-asset ratio hides a range from just 11% loan-to-assets to 73% under the same framework, it's clear that some credit unions are faring better than others at meeting the lending needs of their members. Now, under the consultation paper CP125 on potential changes to the lending framework, we are looking at additional lending capacity, which on a prudent basis would facilitate more long-term lending so long as duration concentration risks are managed. So we do think the flexibility is there for credit unions to improve their business models. Now finally, in relation to Brexit, of course, as we all understand here, any form of Brexit will be damaging, with a hard no-deal Brexit especially so. Recognising these risks, the Central Bank has been focused on Brexit since even before the referendum, and we've been working and analysing the risks posed to the economy, to consumers, to the financial system, and indeed to the regulatory environment. For the wider economy, in terms of the economic risks, although we've put out macro numbers, we would also recognise that the effect would be uneven, with sectors such as agri-food especially exposed to the loss of export markets and disruption of supply chains. In relation to the financial system itself, the immediate priority has been to mitigate so-called cliff edge risks of a no-deal Brexit. More broadly, it's important that the financial system is sufficiently resilient to withstand any Brexit effects. It's important that the financial risks to consumers are mitigated, and it's important in relation to authorising firms arriving here that we have adopted a proportionate, robust, efficient and effective approach in line with European norms. Now, given this agenda, it's obviously been a high priority for us and continues to be, and in conjunction with the wider European regulatory community, and in conjunction indeed with the Oireachtas in getting the Brexit bill passed, we do think the avoidable risks of Brexit have been mitigated. But there's no doubt that Brexit, if it happens in a no-deal way, will still constitute a severe economic and financial blow. But let me link this back, is given that all of our work, given that all of the strategy has been to make sure the banking system has high levels of capital and has a good liquidity provision, its ability to withstand a no-deal Brexit is much better today than it would have been if this had happened a few years ago. So with that, let me stop, and I welcome your questions.
Thank you, Governor Ryan. Deputy McGrath.
Thanks very much, Chair. Rounds of 10 minutes or so.
Yeah.
Thanks very much, Chair. You're very welcome, Governor Lane and your colleagues, Mr Sibley and Ms Rowland. Just at the outset to congratulate you, Governor Lane, on your appointment as Chief Economist of the ECB. Wish you luck in your new role, which I think it's some time away yet. Is it June?
1st of June, yeah.
1st of June. Okay, well, very best of luck and congratulations. If I can just start on the issue of Brexit, Governor, and we have the latest estimates today from the joint paper from the ESRI and the Department of Finance as to what the impact would be on the Irish economy under 3 different scenarios. And while the estimates are pretty stark in themselves, isn't it fair to say that those estimates are in the aggregate, but if you drill down into the detail, as you've acknowledged yourself, the impact on certain sectors like agriculture, agri-food, indigenous manufacturing, indeed the impact on the regions would actually be much more acute than the overall numbers published today?
I think that's crystal clear. So, as you know, we have a large multinational sector here, which essentially has a global market. So those firms would not be particularly exposed to Brexit risk. So, as you indicated, it's essentially so many small firms. Their only export market is the UK. and within agri-food, certain segments within that, the dominant export market is the UK. So there's no doubt that these risks are quite concentrated, and given in turn that those industries are also regionally concentrated, there will be very different effects across the country. Let me say that the results that the East Rhine Department of Finance delivered are in the ballpark that we also see. I mean, the economics profession has a fairly strong consensus on what might prevail. But it remains the case that we also have to be, I think, alert, because how this unfolds, you can imagine, if there is a no deal, in the initial days and weeks, there's going to be a lot of disruption. And then the question is, how quickly will some of that disruption be managed through adaptation? There will be a big, I think, market response, because I think everyone who looks at the market I think the market is expecting a deal to pass, or they're overly optimistic about what a no deal would mean.
Yeah. So
I think we would have to be very alert to those short-term effects, while recognising that Brexit is essentially a permanent disruption.
Yeah.
It's a permanent disruption. So in terms of the challenges facing industries, the challenges facing individual firms, and the challenges facing regions. So in other words, we would the government will have to think about all of those factors. How will these regions adapt to this situation? So we're all waiting to see what happens in Westminster, but it's important at this point, I think, maybe to make 2 points. One is those economic consequences are severe, but I would say, and from our contribution, is because this is something where the financial system we've had to make preparations for all eventualities. It is not the case that the financial system will add to those troubles. The financial system will face challenges, but because of the legislation that's been put in, because we've insisted that firms are ready for no-deal Brexit, and because of the comparatively strong balance sheets of the firms, it's not the case that you would have the add-on effect of the bad economic news being augmented by risks of instability.
And is it important to emphasise that there is no cost-free Brexit? I think one point that people may not have fully grasped is that even an orderly Brexit with a transition period followed by a free trade agreement still results in a very significant economic cost to Ireland.
Absolutely. So, I think what we have now, where we have the single market, and when you look at that, the single market with the 4 freedoms and all of the interactions, because even with, say, a customs union, the services trade by and large would be outside that.
Yeah. And
so much of what we do is services that you have that. You have the whatever regime comes in for labour mobility. So unless there's free movement of workers between the UK and the rest of Europe, that's going to be a big change.
Just moving on to the ongoing tracker examination, you like to refer to them as cohorts of customers. So is it fair to say that there are no major outstanding issues from the central bank's point of view in relation to the handling by the banks of different groups of customers? And in particular, I'm referring to the large group in AIB of about 6,000 customers. We can refer to them as the prevailing rate group. You're very familiar with what that issue is. And then similarly in EBS, there are a group of customers who are in the category of variable base rate. Now, we'll go into all of this in more detail with the banks when we have them in before us in the coming weeks. But is it the case that the central bank has, at this stage, more or less signed off on the bank's approach to groups or cohorts of customers such as these?
Okay, let me turn to Derval.
So you've already had the updated information from the Governor that we're at a point where 39,800 customers have been accepted as impacted in the tracker mortgage examination. We're in the closing phases of that, and there are no known big customer impacting issues that we have identified that we have in dispute. You'll recall earlier that we certainly had a very strong difference of opinion identified with the banks, and that resulted in them capitulating and increasing the numbers from, it was about 13,000 at a stage where we reached a strong impasse with them. And because of the work that we've done, supported by you, we've moved that figure right up to make sure that the customers who should be included in the TME have been. We are still doing due diligence and closing out issues in 4 of the main lenders where it is conceivable or possible that customers may still find themselves included in the tracker mortgage examination, but we're not in dispute. We know of all of the groups because we've done significant due diligence ourselves in group reconstruction.
Yeah.
So I'll address some of the specifics that you've identified. The AIB group, the prevailing rate group that you refer to, you and I had a previous discussion about this. They have actually been included in the tracker mortgage examination, but I recognise that not everybody who would want to be returned to a cheaper tracker rate that they would wish have been, but they have the option of appealing inside of the tracker mortgage examination or using any of the other rights that they always had that we were at pains to ensure that we preserved and that have been preserved for them. So there are some issues still under consideration with some of the lenders, and we're aware of what they are. We're monitoring those very closely, and we keep that under scrutiny. But it's true that we expect to close out our examination due diligence in the coming period, where we'll be in a position then to issue a final report. But we're also making sure that payments are accurately made to the group that still need to receive their payment.
So I think if I interpret you correctly, what you're saying is that at the level of groups of customers where overall principles have to be decided and adjudicated on by the central bank, that you have made the calls on those at the level of principle at this stage, and customers are included as being impacted, and then they have to take it through the system themselves, appeals, ombudsman and potentially court. That there's not going to be any fundamental shift from the level of the central bank at this point on those issues.
That's right, but we do know of some issues that are being considered that we have under scrutiny, but they're not in respect of key issues in dispute with the lenders. But principally that's right, but there are some things that we're aware of that are being checked, and that may result in some smaller adjustment to the figure.
Okay. Just in relation to mortgage interest rates, Governor, just the issue of risk weighting capital, and I know the Department of Finance published a paper. I've had correspondence with Deputy Governor Sibley on it, just trying to fully understand it. And it seems to me that a new entrant coming into the Irish market is very disadvantaged in the sense that they have to use the standardised approach, and even for a low loan-to-value mortgage, the risk weighting requirement for them would be 35%. And when you compare that to other jurisdictions, that's a very onerous capital requirement. Now, we had Finance Ireland recently as a retail credit firm. Retail credit firms, as I understand it, are not subject to those risk weighting requirements. But the prospects of a traditional foreign lender coming into the Irish market with those type of capital requirements and offering groundbreaking mortgage pricing, it's just not very likely, is it?
Well, maybe I'll make 2 points about that. One is in relation to banks, and then in relation to non-banks, and then I'll turn to Ed.
Excuse me, Governor.
Please,
vote
sorry.
in the House. So what do members wish to do? We can suspend, go vote, or we can continue on.
I don't mind. I mean, maybe the senators could continue while you guys go off and vote and come back. Let Kieran and Rose in.
I don't think you have an issue suspending if I think it's important that we'd all be here.
Right, so
Okay.
we suspend.
I don't
Deputy McGrath.
Suit people.
I'll have to stay, but if you want to suspend. But we'll just continue now with Deputy McGrath. I think it's the best thing to do.
Yeah.
Okay.
As much as we can out of the meeting.
Yeah, so on the risk weighting and
So one is I suppose the economics of banks, and then we can turn to the economics of non-banks. So if we think about the banks, one way to think about the regulations, the issue about calculation of risk rates and so on, is essentially that is to make sure that banks take a prudential approach to lending. And I think we've had this conversation many times. Like it or not, we had a big crisis here. Like it or not, there has been a lot of non-performing mortgage loans. And as a regulator, and it's important also, by the way, to have a globally consistent approach to regulations, so that regulations are not undercut by different jurisdictions having different views on this. You can argue it's a bit bureaucratic and so on, but below that is the basic reality of, if you stare at the Irish economy, any regulator is going to ask questions about how much is it prudentially sound to lend into Ireland, and this is why there is a capital allocation against mortgages. For non-banks, they don't have that kind of regulatory oversight because they're not taking consumer deposits. So the kind of concerns that regulators have are different. But of course, as non-banks, they have to raise money in the wholesale markets, and then the bond investors and so on will also be making calls about their prudential judgment. And we are not seeing non-banks coming in with kind of super low mortgage pricing. So I do think that this is not the place to look in terms of what will be the key to unlocking the competition in the banking system. As President Draghi said when he's in front of you, and as we said before, some of that will fade with time, because the more we have a stable system, the more we prove we're not going to have another crisis, the more we prove we have a mortgage market that works, some of those concerns will fade away. But where we are right now, those remain concerns. But maybe Ed can...
Just to supplement that a little, I very much welcome the engagement we've had. I think it's important to get underneath the covers a little bit in terms of understanding some of the mechanics here. So the engagement's been very positive. I think we need to differentiate a little between, say, a large internationally active firm that was used to operating its own internal models, deciding to start offering to operate in Ireland, versus a start-up entity which maybe doesn't have that sophistication and experience. So yes, on initial lending into Ireland, you'd expect that they would have to apply standardised weighting in either circumstance. But if you were to look at the Irish mortgage market today, I think that's not necessarily unreflective of the risks that's in it. They would have a period of time that they would need to build up the data to show that they were capable of tailoring their own models, their own existing systems, to enable them to really come up with an accurate and appropriate risk weighting based on the lending that they were doing. That would be an existing firm coming in. If it was a newer startup bank, then it's typically will have a longer path to travel to kind of build up that capability in any jurisdiction, and is likely to be on standardised for a good period in any jurisdiction.
Yeah, and just final question, because I'm conscious of time. We've discussed again the issue of cashback incentives a number of times, and I think we have somewhat of a different view on them, and I would just like to ask if the Central Bank has come to a conclusion as to whether or not they should continue to be offered, whether you believe that in the round consumers are well served by what you would regard as product differentiation, what I might regard as a means of ensuring that customers in the round, in the aggregate, do not get the best long-term value. And you've acknowledged yourself in your remarks that mortgage switching, while it's rising, it's still very low comparatively with regard to other jurisdictions. So have you come to a clear conclusion in respect of cashback, so that we know where you stand, and it's a matter for the legislature to do what they believe is appropriate?
Let me turn to Derval.
So Ed may want to join in as well, but we certainly have a view that a competitive mortgage market that offers plenty of choice for customers, both in terms of variable rate products, in terms of fixed rate products of different durations, will be of the best in the best interest of consumers. And we recognise that different types of options have a role to play, so long as they're clear and properly sold to customers. In that context, we're of the view that cashbacks can play a role, but I do recognise your observation that cashbacks, whilst they can actually be cheaper in the first number of years for a customer if you add in the amount of the cashback to that. And if customers then have the wisdom to switch product, in fact, later they can turn out to be the cheapest option of all if people will switch. But if they stay on such an option in the longer run, it could turn out to be a more expensive option. I absolutely recognise that. But we think a transparent market where people switch and have the option to switch, there's role to play for cashback, so they're properly sold. Last year, we did a piece of regulatory work on the advertisements for cashback because we saw that they had to be tightened up. And we also did some consultation work, you'll be aware of, on the transparency around the different mortgage options, where we strengthened the framework on the disclosure with regard to cashbacks. We've also changed the framework about telling people on an annual basis about cheaper options available to them from each lender, which we think will result in better options for people, and they could save money. We're clear that a lot of Irish customers could save on the mortgage products that they have if they shopped around and they switched, and we would encourage everybody to take that course of action. The last observation I'd like to make on this is that this is in a different area to other kind of interventions. There would be no role for the central bank to intervene on cashbacks unless they're in a situation where we saw them being missold, and we don't see that in the market. But we recognise there can be better value for people if they would shop around, but that could be said right across the suite of mortgages. There's a lot of value for people who would go to the trouble of switching, and because of that, we've strengthened the approach to switching to support people in exercising that choice.
So in essence, very finally, is it the view of the Central Bank that they should be retained, or is the Central Bank neutral on the question?
So I think it's probably accurate is the neutrality. Banking is a commercial enterprise. You know, it's not our, you know, we don't have that kind of product gatekeeper role saying, well, we think we support this product over another. So we're not in that kind of endorsement role. But as Dermot said, it would take a lot to shut down an option, because if the mis-selling risk is being managed through making sure that the disclosure is correct, the advertising is not misleading, the way it's set up is these are commercial choices.
I mean, just to supplement a little, I mean, we've been talking about mortgage pricing for a number of years now, and I can understand a degree of impatience in terms of where they are today. But if we compare, say, the mortgage market today to where it was 2 or 3 years ago, then large elements of the dysfunction have been addressed or have certainly been reduced. Now, there are still elements of dysfunction in the mortgage market today, but we are moving to a market that is more risk-based, more risk-sensitive, that there is greater differentiation in the market, and we are seeing consumers take advantage of that. So if we look today, then the lowest rate on offer today is 2.3% for a 2-year fix. There's a variable rate at 2.75%. We are seeing that switching, which was at the trough in the hundreds of transactions, down to 1 or 2% of the number of the transactions that were taking place at the bottom, are now up to about 12% of transactions that are taking place. The work that's been done to try and really highlight to borrowers the ability to move product with their current provider. And there are lots of customers that can save money by changing product with their current provider, and then lots more that can save more money by switching provider. And so that there is work to enhance, and that again would improve the discipline in the market and make it function better still. So there is a lot of work done. It's clearly not functioning as one would optimally like, but it is in the right trajectory.
Thank you.
Deputy Doherty.
Carla, this was a robe. Can I begin also, Mr. Lane, Governor Lane, by congratulating yourself in your new appointment. I wish you all the best. An uncontested position. Many of us would like to contest those type of elections, but it probably speaks volumes of how you're regarded by your peers. So I congratulate you and wish you all the best. I want to just ask, in relation to your code of practice on the sale of mortgages, is it still in effect?
The voluntary code?
The code, yeah.
Yeah, I mean, I think that's correct, but it's as a voluntary code.
I just wanted to know. I just want to know if because I have a follow-on question.
Okay.
So the first line of that code, we'll remind ourselves, says that a loan secured by a mortgage on residential property may not be transferred without the written consent of the borrower, which is what I've done is really taken your code, which is voluntary, which no bank has ever applied, and the central bank has not ever, to my knowledge, asked the banks to apply the code, and I've just basically put it into a statutory basis, and thankfully the majority of elected deputies have supported that legislation. You now paint a picture that your own code will create a nightmare scenario for banks, for consumers and for the wider economy.
Let me make two important exceptions. One is there's a basic difference between a voluntary code and a statutory code because of the obvious differences in terms of compulsion and the consequences for not following the code. And in a minute I'll turn to Derval on the history of this code. But second, and very importantly, is in that code it does make the exception for conditions of financial distress. Now, I recognise in the bill being put forward, there is a financial distress exception, but my point in the opening remarks is it's too narrowly defined. It's defined in terms of failing or likely to fail, which is really like end game type issue. Whereas our point, and it's throughout our whole approach to this issue, is it's very important to anticipate and preempt financial distress, including by where it makes sense, by loan sales, which reduces the risk, the national risk facing us in the next downturn. So we think, although of course there is that basic similarity for the reason you gave, the issue of compulsion versus voluntary and the scope of financial distress means that we do think it would have those adverse consequences. Maybe the third point I'll make is compared to then, 30 years ago, nearly 30 years ago, the role of transferable loans in the financial system has just become so much more important. Honestly, at that time, the likelihood of a bank needing to raise liquidity from a central bank on a collateralised basis is much less than we would appreciate now. The importance of securitisation as a technique is much more prevalent now than it was then. The role of collateral in the interbank market, because so the world has changed. But even if as in terms of the code itself, there's a difference between voluntary and statutory, and then this issue about the conditions of financial distress. But I think it's interesting also to think about the history of this. So
I'll just give you some context. It arose in the aftermath of the central bank back in 1989 becoming responsible for supervising building societies. And if you had a mortgage, you might recall, with a building society, you got rights to vote. That could be relevant. There was a lot of talk, I think, about it in subsequent years, conversion rights. And that might lead to windfall profits. It didn't transpire that way. But that was before securitisation of mortgages took off in the market. And there was a concern at that time, because we were in an immature state of evolution, that if your mortgage was securitised, you would lose your voting rights, which were valuable to you in terms of the decision to convert from a building society to a public limited company and any profits that might ensue to you. So it was entirely in that context that the voluntary code of practice was put in place. It was with an eye to that. And since then, things have changed dramatically, and we would never now issue anything on a voluntary basis. That's not the way the regulatory approach works. We either do things on a very solid footing, which you see in respect of the Code of Conduct on mortgage arrears, and we see there's no actual benefit conferred to a consumer with respect to this proposal, because all of the rights and protections that they have apply equally, whether their loan is owned by a bank or a non-bank.
So, you outline obviously the origins of this here, but the code still exists today, and I assume the central bank just doesn't introduce a code and leave it for 30 years. And like numerous deputies, including the current finance minister, including myself, including I'm sure many deputies in this committee, have over the years raised questions in relation to the code. Now, we know how parliamentary questions work. They go to the minister, they go to the general secretary, they go to the governor of the central bank. I assume when Minister Noonan answered the parliamentary question, which was actually tabled by the current finance minister, Paschal Donoghue, and when his response came back on the floor of the Dáil, written answer says, notwithstanding the voluntary nature of this code, I expect all state banks to implement it in full. That it was flagged with the central bank at that question, and indeed his response was, I assume, known to the central bank at that time.
Well, I mean, I think, first of all, before my time, but second, I mean, I think it's fairly clear parliamentary questions are a responsibility of the minister. I mean, of course, we would...
You're consulted on them.
Yeah, but there's a difference between consultation and sign-off. So the responsibility for that answer would lie with the minister. And let me be clear. I mean, in general terms, of course, if there were no downsides, asking permission is, in principle, in general, a positive feature. So asking permission, I think, has its own merit. But given the nature of the modern financial system, where loan transferability has become a big part of the funding of banks, and especially under crisis conditions, it comes back, even within the code, it had that financial distress exception clause. And I think the main difference between us is my view of that is forward-looking, anticipatory, and it is not the case that the Irish banking system is in a situation where that should be restricted to failing or likely to fail. And I think coming back to what I've said here today and before, the loan sales are important from a macro national point of view. Leaving all of the risk of these loans in the Irish banking system is just, we've had it before. We do think this is an excessive level of risk, and it is important to reduce the risk in the banking system. And so in that context, I'm comfortable with the situation we have where we say that financial conditions are not stress-free. There's genuine risk there, and this is why we do really insist on this approach of reducing non-performing loans in the banking system.
Like, I've seen your comments in the paper this morning, and I must say I wasn't surprised, disappointed in relation to your view. We've discussed this previously, and we'll be discussing it again next week when the bill goes through pre-legislative scrutiny. But I must say there is a bit of a trend here from both the Central Bank, the ECB and the Department of Finance, when members of this Parliament, indeed this committee, bring forward legislation that we believe is in the interest of consumer protection. We have what I would argue is scaremongering. We have the Central Bank telling us today that my bill will increase interest rates. We've had the same attitude from yourself in relation to Deputy McGrath's bill on capping mortgage interest rates. We've had the Department of Finance telling us that the regulation of vulture funds will increase interest rates on consumers. Now, that bill has been signed into law, 6 months ago, and it hasn't done that. I take some of it with a pinch of salt. However, there are other issues that I think that we need to discuss in the context of pre-legislative scrutiny. The final thing I'll say in this here is the issue in terms of securitisation, which a lot of focus has been put on. It is not the intention of the bill to prevent that type of passive securitisation where For example, and if you look at Section 3 of the bill, but maybe needs to be clarified further, where vehicles are set up within the bank group itself, such as AIB's system, where they're able to securitise then. That's not the intention, but I make no bones about it. This is about giving the power to the borrower to prevent the sale to a vulture fund if they so deem fit, if they think that that's the right thing to do. And while you make the point, and you've done this on a number of occasions, that there's no difference between a bank and a vulture fund. If that's the case, then the borrowers will have no problem giving their consent. But the reality is that there is a big, big difference. That's the reality of it. The reality is that many of these vulture funds do not offer the type of solutions, the type of restructuring arrangements that the banks have offered. We know that they have short-term interest, where banks have long-term interests. So it is always better, if you want to keep the roof over your head, and if you're making a genuine attempt to be with a bank on average than with a vulture fund.
So, I mean, I appreciate, we have this difference of views. So let me make 2 points. One is, what we say is the regulatory framework is the same, whether it's a bank or a non-bank. So what we can offer in terms of consumer protection is the same. Then the question
Can I just ask in that, with respect? And that's fair. I actually don't dispute that one bit, because we're on the same point here. But you know, and I know, that certain funds out there do not offer the type of arrangements that others do. So from a Mary or John sitting out there, the idea that they're regulated the same doesn't mean a blind bit of difference to them if they are not able to have the same type of restructuring. We've talked about 100.
So I appreciate this is a different issue. So then the issue is, are the outcomes similar or different? And can you rank the outcomes where you say your belief is that the outcomes are going to be better with a bank compared to a non-bank? And this is why it was so important when we did the CCMA review last year. There's a big data effort there to see what's actually going on. And our commitment is to continue to look at that, because as of last year, when we looked, we don't see systemic differences in the outcomes across the banks and non-banks. I think it's an open issue for the future.
But you're talking about the CCMA. The CCMA does not require any bank or any vulture to offer any type of solution.
So what I'm saying
it's just procedural stuff. And while there's no evidence of them breaching it, the reality is that they take a very intolerant approach to a certain amount of customers. And I'm talking about vultures funds here. And if you talk to debt advocates, they will make that very clear. The CCMA is, if you want to focus on the CCMA, then in my view it's a red herring when you deal with this issue, because that's a procedural area that they have to go through before they go to the item of last resort, which is repossession. But they don't have to offer a solution, and that's the big problem. That's where the weakness is in the CCMA.
Well, I mean, I don't think it's a weakness of the CCMA. It's a kind of the nature of what a regulation can do versus, if you like, the issues about the strategies of these banks versus non-banks in terms of the menu of what they offer. So what I was saying is, in the course of doing the CCMA review, we did look at the data about what's going on with the loans with the non-banks versus the banks. And what we're saying is we don't see this different trajectory where consumers with non-banks are systematically worse off. And as we've had the exchange before, your supposition is the long-term commitment of a bank to its brand here, whatever, means that they're going to be maybe less severe with a debtor. On the other hand, banks have high capital charges, and banks also have to maintain a lending discipline into the future. Whereas the non-banks have bought these at a discount, they don't have the same capital charges, and as you say, in terms of their strategies, it's not obvious which group is going to, in the end, be better off than the other group. And this is why we, as a central bank, are saying, because we have this data collection power, every year we're going to come back to this issue, because you have a strong hypothesis there, which I'm not convinced that's true.
That's okay. I've read your report, and I think one of the key things in terms of your report is as well, you make the point that it's very early to say in relation to the funds, because we're talking about a small amount that has been transferred at the point where you were looking. Right. We're obviously seeing a huge amount that's being transferred or is in the course of being transferred over the next period of time. And we also know that the CCMA set a time frame. So when you look at the outcomes at the end, where they're not at that, they're either at the starting point or the middle point. When you actually talk to the debt advocates who are in there dealing with the borrowers and dealing with these vulture funds, they tell you a very different story, because they're not looking at the end result, they're looking at it right here, right live, and they're telling us now, if you continue to allow the gates to be opened and allow these vulture funds to take up all of this type of debt, then we're in for a serious problem, especially given the amount of long-term arrears that are in the system. But I want to, and I'll let you, because I've got a connected question here. Project Beach, AIB sale to one of the funds, most likely Cerberus. How many PDHs, how many principal private dwellings are involved in that sale?
Okay, let me turn to Ed.
So if I could just, we're very limited what we can say about in individual banks and particular transactions. If I could just make one or a couple of broader points. I think we're coming back to a specific session on the no consent no bill. I think next week. So obviously we'll get into more detail there. Our broader feedback in terms of some of the things that have been presented and we've been asked for our view on is really in connection with the point Deputy McGrath was raising, which is about the functioning of the market and interest rates in the market. So an intervention, a specific intervention in one spot, what's the wider implications for it, and trying to anticipate that. That is the basis of the feedback that we're giving. In terms of the amount of reliance that banks had on securitisation, it was in the tune of about 38, nearly 40% of mortgages were securitised in 2011, and today it's in the region of about 23% in terms of relying on using them for collateral purposes, including securitisation. So it is a very important source of funding. If there are issues with that or concerns around the legislative framework in Ireland, then the point about competition, new entrants and the like, I think is relevant. So that's the kind of a broader point. In terms of Beach, I think that's probably more of a question for the bank. I understand that they're coming in. We can talk about our approach to sales in terms of making sure that we very much focus on the consumer protection risks associated with sales, with any sales that have owner-occupier or primary dwelling homes associated with them. The engagement we've had with banks in the past, we can talk in general terms rather than the specific how many.
I appreciate that, Mr. Bank. I appreciate that. No, thanks. Just the issue is that AIB have presented the sale as commercial property. Mm-hmm. They've made a virtue of the fact that they do not sell to vulture funds private homes. Now, people are going to be getting thousands of letters will be going in the post in the next 2 to 3 weeks. Up to 7,000, 8,000 people will be receiving letters to tell them that their loans are being transferred to a vulture, to Cerberus. In the middle of that is going to be private homes. Now, we talk about the culture of the banks and all the rest. Like, is the central bank aware of the number of private homes or principal private dwellings that are included in this sale? Do you have that information? So
with any sale, we would engage with the bank about what was in it and the approach that was being taken, and if there were primary dwelling homes associated with it, we would be engaging with the firm on that basis.
And are you aware whether these sales of these homes, of these loans, which secure the homes that families are living in, whether they are meeting their terms of their arrangement?
So this is getting into the specifics which I can't really cover. Where I have seen this in the past is where there are connections between commercial loans and owner-occupiers. That might be the case.
The last point, can I just ask one final point? I'll maybe get in a second round. But in relation to Brexit, we've had the SRI report that Deputy McGrath referenced earlier on today, and we hear in terms of a disorderly Brexit that over a period of nearly a decade you'd have a 5% reduction in output. Now that's kind of shocking everybody because it's becoming a lot more real to people of the possibility of that outcome. But the central bank's assessment is a lot more stark. The central bank's assessment is that it wouldn't take 10 years to reach that type of level, but that in year one we would have a 4% reduction in output. Have you any, given the SRI's report, are you still satisfied that your assessment on the impact of no-deal Brexit hard crash is that severe? And have you been able to extrapolate that reduction in output in terms of the impact on the wider economy in billions and the number of jobs in tens of thousands?
So I think the approaches are consistent, because essentially what we would see in a no deal is an immediate hit because of all the disruption, the market fragility, the loss of confidence. So you'll have those kind of contractionary forces because of the shock. And then as that shock fades away, then you have the long-term reality is we're going to be less productive, the UK will be less productive, and that's why you get these numbers like 10 years from now, there'll be 5% lower GDP. So the same approach will give you both answers, which is a big hit initially, a degree of recovery, but never back to where we would be without Brexit. So the fact that we're saying in year one there'll be 4 percentage points knocked off the economy is consistent with this longer-term forecasts. So because there will be adaptation, the world will adapt. That doesn't mean every firm will survive, every region will be equally better off, but there will be adaptation over time. So it's important to say this is compared to what would happen in the absence of Brexit. So 5 percentage points over 10 years doesn't mean we will be 5 percentage points below where we are now.
Yeah. It's
compared to a growing economy. So it's something that's an avoidable cost if they avoided no-deal Brexit. But it's also the case there's many other dynamics in the economy. So.
Thanks, Deputy Burton.
Thank you. And first of all, you're very welcome here today, and I want to wish you good luck in terms of your new appointment, and congratulations. I think it will be a significant appointment, obviously not just for you personally, but also for Ireland. It's the 10th anniversary. We're in the 10th year since the banking collapse happened. And I think you would agree that ordinary people in Ireland made many sacrifices to bail out the banks. And a lot of people lost their jobs, and lots of people took wage reductions and tax increases. But the economy, as is reflected in the Central Bank report, is now back at effectively close to full employment. But what I'm concerned about, Governor, is that the banks in many ways are back to their old tricks, and in many ways the atmosphere of these days is very similar to what it was in the years before the financial collapse. The banks appear to have, and I think Mr Draghi, perhaps you yourself, share the view that there is a moral hazard when people fail to pay their mortgage debts. And I think we all understand the concept behind that. But what I don't understand at the moment, and I would like you to comment, is that the lobbying for the return of very high salaries and improved salaries for bankers in the bailed out banks has continued apace. And there's also a lobbying for a return of bonuses. Now, I know some of this is a decision, if you like, for the Minister for Finance, but I would like to ask you, do you feel that it's appropriate that bankers in Ireland, in the bailed out banks, the chief executives, where there is a pay cap in force, do you think that that pay cap should be relaxed? In recent weeks, there's been renewed lobbying by a number of banks in relation to raising that pay cap and to returning to effectively a culture of extraordinarily high pay for bankers. Moral hazard seems to exist in terms of little people who have a single residential mortgage on their home, whereas the banks just seem to me to be back to their old tricks. So I'd like you to comment on that. Is it wise that we as a country could see bankers now going up above the 500,000, 600,000 mark? Would the central bank resist that? Would you have advice as you depart for what Ireland might best do? And secondly, alongside that, there has been a renewed return to massive escalation in land prices, particularly in all of the major city and town areas of Ireland, as there was. It went absolutely off the Richter scale in the 2 or 3 years before the collapse. And that's the second reason why I'm concerned that we haven't fully learned the lessons of the past. And I'd just like to know your response as Governor to that.
Okay, I mean, I think the general observation is, is this time different? Are we going back to the situation we had in the mid-2000s? Let me talk a little bit about that, and then I'll ask Ed, who leads our prudential supervision on the issue of bank bonuses and bank pay levels. I think it's important to say is this is, first of all, a very volatile economy, intrinsically volatile. In that period, there was excessive optimism that Ireland would never face a recession, prices were only going one way, that we were unique in some sense. Then we had this horrible crash, very severe, protracted crash, which, as you indicated, has led to so much pain for people who lost their jobs, who were, by basically being unlucky enough to be of the age where they were taking out mortgages in the mid-2000s. So there's all of this pain. And everyone now, because of the high debt, taxes are permanently higher. And they're not being used to fund hospitals, all of that. Part of that is being used to fund the costs associated with the bailout. So there's no doubt, I think we all, and a lot of the work we do, and I think, pretty sure the reason why we work in the central bank is to avoid going back to that situation. And so a lot of what we're doing in terms of making sure the banks have enough capital, which basically means they're not leveraging themselves too much. We're avoiding that. With the mortgage rules, we're trying to avoid the desperation of credit pushing prices higher, people in desperation saying, well, I have to get in and taking on too much debt. So to avoid a spiral between credit and house prices, we're working hard on that. And then what we have also seen is this change in the nature of the financial system. Because the banks are more severely regulated, we have the entry, one reason, and because of the fact that they've had so many legacy issues to deal with, now, as you know, a lot of the land, a lot of the office blocks, a lot of the kind of rental apartment buildings are being bought by non-banks. So global firms searching the world for good investment opportunities, and it does mean prices will be driven up higher here because of that global capital. So my point there is it's not just about the domestic banks, which caused the problem the last time. Now the financial system has non-banks. The system we regulate here has a lot of internationally focused operations where pay levels are high. And then we have our approach to the domestic banks. And then this issue about pay levels, which again, as you indicate, are in relation to the state-owned or state-backed domestic banks, is a particular issue, but I'll turn to Ed.
Just before I come to pay, so just to add a little bit of colour to the Governor's remarks, certainly within the bank, certainly I personally am driven by ensuring that what happened here before and the pain and costs, human costs associated with that don't happen again. We are we operate in a fundamentally different environment from a regulatory and supervisory perspective. So in terms of the regulatory framework, both internationally and domestically, is fundamentally changed. The philosophy underpinning it, underpinning our approach to supervision, has fundamentally changed. The requirements around capital the banks have to hold, how they have to fund themselves, how we can move towards being able to resolve them without recourse to the taxpayer, all that has fundamentally shifted. Our expectations around governance, risk management, control, all have changed. So there has been a lot of work done, both internationally and domestically, to address the failings leading up to the crisis. Specifically on the point of pay, and I know it was raised by the Chair last time, and I think he was not entirely happy with a kind of somewhat nuanced response. I don't see a case for raising the cap in the domestic retail banks. That is a matter for the shareholder. Now, clearly, there will be different candidates available to operate in those roles at a higher salary level, but I think it's perfectly plausible to find people to work in those roles within the salary cap. Where I think there is a case for thinking carefully is around what's happening underneath those levels, and how remuneration works and the level of remuneration in some of the kind of critical functions within roles, where there are those that are subject to the cap are competing against firms that are not subject to it and potentially are at risk of losing critical staff in risk management, in analytics, in how they face into customers as it stands. And I think there is merit in elements of variable pay in those circumstances, and looking at variable pay in those circumstances, subject to it being well designed, making sure the incentives are aligned with the culture that's desired stated within the institution, that it's consistent with the rules that are now in place in terms of having clawbacks if people are being overly short-term in their thinking, that risks aren't being managed. And I think there is a case for thinking in those terms. It also allows firms, banks, to vary their costs according to the circumstance that they're in. So if you head into a downturn, if you have a very high fixed cost in terms of fixed salaries, the options available in terms of cutting back costs are different to those if you have a kind of more variable element. So I think there is a case for looking at variable pay. I don't think it's at the top level. I think it's much more into the people working within those institutions, and it would have to be very well designed, consistent with the rules and all that we're doing in terms of the culture within the institutions.
When you say variable pay, Mr. Sibley, do you basically, that would mean bonuses or include bonus type pay?
So, yes,
in other words, performance result-based pay. But, and I might put this question to the Governor as well. I mean, one of the things that's plaguing Europe at the moment in terms of its democratic institutions, and ultimately I would say is a risk for the Irish Bank, but also a risk for the European Central Bank system, is populism. And populism is partly driven by insecurity, precarious employment, and the fact that some people are doing awfully well in a global financial system, just as you've described, but other people are not. And they don't really see an argument as to why people like bankers should earn extraordinary amounts of money and why there should be a return to the bonus-type culture that really distorted, particularly in cases like Lehman's, and I think that we're all familiar with from TV and films and so on. So I suppose asking the incoming chief economist, I mean, do you see a case, for instance, for ordinary workers, both in public and private sector, getting pay, remuneration and increase in a structured, orderly way, but would you also be cautious about people at the very highest echelons going back to the culture that really in many ways drove the bank crash, where bankers effectively were masters of the universe. That was their title. And we all know there were Lehman Brothers, but no Lehman Sisters. There are many more sisters now in banking, thankfully. But nonetheless, if you saw, I don't know if the bank follows the price of development land in Dublin or the deals that are being done at the moment, the increases in values are truly extraordinary. And it's very difficult for people who may now be renters for all of their lives because there's no affordable property. I mean, where does both the European Central Bank and the Irish Central Bank have a view? Because, I mean, this is a critical issue I mean, you were talking about disruptive risk in relation to Brexit and permanent disruptive risk, and I agree with you on that. But equally, deepening levels and examples of inequality are an incredibly disruptive risk for democracy, and a permanently disruptive risk as well in the same way. So I just wonder, as you head into your new job, how will you approach these issues?
So I can assure you that central banks globally, here across Europe, are paying a lot of attention to these issues. And because, you know, over and above just the wider issues you cite, there is a clear feedback to the financial stability, because if you have very consequential developments, such as Brexit, I mean, we can argue about what lies behind the Brexit impulse. It's clear that we do have to pay attention to these issues. But there's so many elements going on in what you say that I think it's important also to kind of go through any individual issue in terms of that narrative and say, well, what elements of that narrative are relevant to the issue in question. So the issues about the future of work, the future of who's going to win and who's going to lose from automation, who wins and who loses from globalisation. That's very important, even from a macro point of view, because we know, for example, that consumption profiles of those on middle or lower wages are very different to consumption profiles of the top 1%. I mean, that's a big part of what's going on in the world economy, is that shift in income. It does have consequences for the levels of demand in the world economy. So absolutely we would share the observations. Let me come back to the land issue, which I indicated. It's also important to say, who's taking that risk? Who's taking the risk about speculating on high land prices? Unfortunately, in the mid-2000s here, in the end, the risk was taken by the taxpayer, because it was banks making excessively risky loans because they were funded by our deposits and bonds. The government ultimately stepped in and it landed on the taxpayer. It's quite different when it's a global investment fund who's buying at those prices, where the risk is elsewhere. So I think the risk profile of what we're seeing now is very different to what we saw then in terms of who's taking those risks. As you know, in the world of super low interest rates, the case for saying, well, if I can buy a rental yielding property, that looks more attractive than holding a bond or a bank deposit, that basic economics is there. But it's very important that we prevent the banking system from taking excessive commercial real estate risk. And that, by and large, is true across Europe. I mean, we're putting a lot of emphasis on making sure that the risks in commercial real estate are not being concentrated in banks. And then, as you say, I mean, this goes back to ultimately the political source of the cap on pay is, I presume, at the time and ongoing, is sourced in that political dimension of how do you explain lifting that cap in the context of inequality and the beliefs of typical people. So it's very much, and as you know, elsewhere in the Netherlands, it's a big issue as well. So these are complex relationships between the crisis, but non-crisis sources of inequality like automation, big tech and so on. And I would also emphasise is it's much wider than the financial system, because as you know, when you look globally, a lot of the new fortunes are in the technology sector. You know, and also in terms of the popularity of banking versus tech for career choices, I mean, that's moved a lot in recent times. So there's a much wider agenda here than just the banking system.
Thank you, Burke. Now to Senator O'Donnell.
Thank you. I want to join my colleagues in wishing Mr Lane all the best in his new appointment. Can I just, I suppose, take you through your presentation? First area I actually want to touch on is Brexit. And you made in your initial opening statement, you spoke about growth rates of 4.9% to 4.7% for 19 and 20, unemployment 4.9, 4.7%. You said wage price levels would increase by 3.4% and 3.6%. Factoring in with the ESRI and the Department of Finance report on Brexit on the three scenarios, deal, no deal and a disruptive no deal. Are those figures Brexit proof? Are you changing those figures in light of the fact of the ESRI's analysis today, which states that in all scenarios now moving forward, regardless of what happens on Brexit with the UK, it's going to have a negative impact on the Irish economy?
So these figures are based on a deal. Because under a deal, there's a transition. So in 2019-2020, the immediate disruptive impact of Brexit is not going to be there.
But if you look
but on a no deal, we've also published our no deal. So of course, if there's no deal, the picture looks quite different. So on the no deal, we said a few weeks ago.
So this before you go there.
Yeah.
Under the deal on the ESRI figures, they're speaking about a reduction even over the next 2 years. So they're speaking about a reduction. Are your figures for 19 and 20, did they factor in those?
Sure. So compared to Brexit not happening, these are lower numbers. Absolutely.
And how much lower are they? That's what I suppose I'm interested in the central bank's analysis on Brexit. How much of a factor do you believe?
I think we would have pretty much identical views to the ESRI. So the impact of Brexit, I mean, I think if you look across everywhere, it's not the case there's a major difference of views across economic modellers, whether it's here in the UK, in Europe, because essentially we use the same framework. So there isn't really a difference of views about the predicted impact of Brexit in the near term, the medium term or the long term. So the consensus.
So in your view, Mr Lane, are there any circumstances in which Ireland as a country could in any way gain from Brexit of any form, either under a deal, a no deal or a disruptive no deal?
I'm not familiar with any economic approach which would say breaking up a single market is beneficial. So no.
In any sector?
Well, any sector, I think that's going a bit far. But in the aggregate, Ireland will be worse off under any form of Brexit. I think I'm certain about that. I mean, obviously, and taking our own, the world we regulate, certain types of activities will expand here, but that's a minor side effect compared to the damage caused to the.
What areas would you see expanding?
Well, export-orientated financial services. So these asset management firms, investment banks, clearly they would not be.
Are you seeing a major influx of, we'll say, UK-based banks setting up operations in Ireland in terms of job creation? Are you seeing much of an uptake in that area in recent times?
Well, we've been clear that there's quite a lot of activity. But we have two major banks who have been authorised, Barclays and Bank of America Merrill Lynch, and these will be big operations. There will be new jobs there, but that's a drop in the ocean compared to the wider impact of Brexit.
Okay. Can I move on to the area of the whole area of non-performing loans, and you make reference on page 6 where you speak about non-performing loans being sold to funds. And you make reference to that the transfer of credit risk and funding risk to investment funds that by loan constitute a national reduction in macro financial risk in those funds are primary overseas. I suppose it's in the context of Brexit too. We're getting it from people dealing with the funds, primarily that many of them are 100% geared, or effectively investment vehicles that borrow heavily themselves short term, and they're buying products that would be long term in orientations like mortgages, and that their business model is not based around doing restructuring on home loans over a longer period of time. That's number one. Number two, in terms of reducing national reduction in macro financial risk, we still have probably out the order of up to 25 billion of taxpayers' money invested in AIB, Bank of Ireland and Permanent TSB as we speak. With the whole impact of Brexit, what impact do you think Brexit will have in terms of the Irish government being able to in time divest the investment in the mainstream banks, which will of itself reduce, I would have thought, in a far more material way, the balance sheet of the Irish state as distinct from the funds?
So on the first issue, these investment funds are, I think, overwhelmingly foreign owned. And that's a pretty basic and important feature, which is if there were a new... I do not dispute your finding that it reduces the exposure. Yeah.
However, I'm making a point that if you go back to the fundamental mission statement for the central bank, it's to protect the interests of, it's about the financial stability, monitoring financial stability, and operates in the best interest of consumers and the wider economy. We're duty bound to ask the question.
Sure.
And you made reference to it earlier, right? But I'm just putting, I suppose, a view that in many cases we're being given the view that many of these investment funds are not strictly investment funds. They're funds that would have borrowed from maybe pension funds abroad. They're 100% geared with short-term source of funding,
sure,
borrowing for assets that in profile are long-term, which would be home mortgages for people.
So let me make 2 points about that. One is, I'm sure these funds are geared, but I think 100% gearing is far from accurate.
They're highly geared.
But remember, banks are highly geared. So in terms of, compared to a bank, they're less geared typically than a bank. So,
I'd slightly dispute that, no.
We can maybe follow up. I mean, it's probably better to do some factual analysis on that.
I'm asking, have you done factual analysis around that?
I mean, I do recall, I think we had an exchange with Deputy Doherty on a particular example where my recollection, the example we went through was about a gearing rate of about 25%. So it's nowhere near the gearing of a bank. But I think that's kind of a secondary issue. I mean, we do now, when we think about what could happen, the gearing, the debt of these funds, we do think about, absolutely. So the fact that a scenario where investment funds lose access to funding and then their conditions change, we do look at that, we do think about that. So that's a clear risk factor for the future.
Yeah.
But the scenarios in which that's going on are also scenarios where I think where banks are also facing issues as well. And then the issue about the investment funds, this issue, I mean, I think it's an ongoing issue about today into the future, about, by and large, the restructures they have are partial. They might have interest only or some intermediate case. And, over time, the issue of how the... Well,
can I ask, rather, because my time is... Can I ask the Governor that the Central Bank will continue to undertake empirical work around that area, because we're dealing with people on the ground, both people that would be acting on behalf of people that are in distressed mortgages, where the mortgages have been sold on to funds, plus the individuals themselves.
Yes,
and maybe that there would be empirical work done around that area, where effectively, if a fund is borrowing for 5-year funding, but they're buying assets, and I take your point, but their model, in many cases, does appear to be a short-term model, whether that's real, and that's your role as a central bank. So we'd actually look at that.
We would absolutely agree with that. In terms of, we're committed to that, in the sense of we're committed at different levels. Levels in terms of the stability system, but also in relation to what's going on fund by fund.
Fine.
We're committed to collecting.
Well, then I'd ask, Chairman, that at a future date that the Central Bank would report back to us on their updates.
So maybe, because we did it last year, and this is an ongoing issue now, but
So, precisely to your point, understanding the restructures that are being put in place by the banks, by the non-banks, and how that works out over time was a key focus for us in the CCMA, and one of the chapters details the types of arrangements that they have, but that's a point-in-time analysis. So what's really important for us is that we can see, for example, the most popular approach that was being taken by the non-banks, I think, was arrears capitalisation, but they have a different loan profile than the banks. So it's really important that actually supervision of the non-banks and their treatment of customers and the sustainable arrangements that are put in place is a priority area for us in supervision. Fine. So on an annual basis, we're going to collect that data and scrutinise it to see how those loans and the treatments are working out over time, because straightforwardly, if we see problems in the way that they're treating their customers, we're going to correct that in our supervisory work.
And will you publish those findings?
Yes, maybe if I just supplement a little. So there is there's layers of work that we do. So on a quarterly basis, we get information from the banks and the non-banks in terms of their loan books, the restructures that are in place, and as Derval has referenced, there is a marginal tendency for more arrears capitalisations in the non-banks than the banks, but it's relatively marginal. They're split mortgages in the non-banks, and other solutions there as well. As well as that kind of quarterly cut, there is also then deeper analysis that's undertaken, kind of both from a data perspective, but then also on-site work. And there is, both in terms of what we did last year and what we will do into the future, that work, that on-site activity, supported by high-quality data analytics, and is undertaken in the banks and in non-banks. You raised a point about the share prices.
I want to see that. When you were speaking about risk, it just struck me. We've 25 billion in the Irish banks at the moment of taxpayers' money, right? It's sitting there. That's a risk to the state. That's a risk to taxpayers' money. I'm just saying that is, do you see in time with Brexit what impact that will have? The share price of banks have fallen in recent times with Brexit, and I've been following both the Irish and the UK banks, and they're both, I don't know how they're doing today, but they have fallen.
There is a wider European decline. So there's a pretty big decline in the last year. Yeah. I mean, I'm not so sure the current value is near 25 billion. But
but I'm just saying.
Yeah, I know, but it's significant. No matter, it's billion,
well in excess of 20 billion.
Well, we could maybe follow up on that. But the bigger point is, I don't view it as a contest to say that either your strategy to reduce risk is to maximise the value of and then dispose of the shares, versus this issue about the balance between the banks and non-banks.
Well, I'm making a statement with Brexit and whatever that's happened. Where do you see that impacting on the state's policy
of
over time.
Of course, Brexit on its own is negative. That's no doubt. I think the broader issue, which is a European-wide issue, is about the future of banking, where the interest rate environment in Europe is going to be, and so on. So it's one factor among many. I think the overwhelming pattern has not been Brexit. It's just the wider concerns about the future of the banking system. Which is, it's a fluctuating debate, but I don't know if Ed has any...
So it's certainly something that we're very actively looking at from a kind of warning indicator, and we can see that there are definitely fluctuations in the Irish share price relative to European bank share prices connected with news that's coming out of the UK. So you can see that there is probably an element of Brexit associated movement there. To the Governor's earlier point, that there is generally underperformance in bank share prices across the EU, concerns around return on equity that European banks are making relative to the cost of that equity in terms of people investing in them, and that is also features in Irish share prices.
I have two quick final questions. The whole issue around the trackers and so forth, on page 3, you said, finally, our enforcement work is ongoing. Details investigation are detailed and forensic. You might give us an update as to where those enforcement proceedings are, how many institutions are involved, what you see the time frame on taking action.
So I can remind us that there's actually an enforcement case against Springboard was previously concluded with a €4 million fine imposed, and there are 6 open enforcement investigations against all of the main lenders. They're at various stages. I anticipate that some may conclude this year, but they all depend on the evidence acquisition and the interview schedules and the issues arising in each case, which will all be different depending on
all the mainstream
facts.
lenders in Ireland are...
Yes,
okay.
and individual culpability is part of the consideration in those cases, which means that it is even more forensic and more detailed, because we will consider all options and all angles in those cases.
On the credit unions and the whole issue on... I've reviewed that this credit union should be inhabiting a public banking space, whatever you want to call it in that loose term. Has there been any approach made by the credit union movement, we'll say the League and CUMA collectively as a group, CUMA or CUDA collectively as a group, in terms of putting forward a public banking model in terms of rollout through their network?
So there's lots of discussion about the public banking model, including in connection with credit unions. And I've personally met Rural Link and representatives of the Spark Council a couple of times, and I have another meeting within the next couple of months on this topic. So there's lots of discussion, lots of thinking going on. I haven't seen a specific proposal come from ILCU, CUDA or any other of the credit union bodies on for a public bank that they are driving. I think they are interested in it and engaged on it, but we don't have
no firm
proposal on it.
Okay. And then the final question I have on page 8.
Sorry, that's to be clear from the credit union sector. I know that there's work that Rural Link have done and others have done in terms of what a public bank might look like.
I have a particular interest in central bank have the network. There is a need for competition in the market. They should be inhabiting that space, in my view. A lot of the work, they're already inhabiting that space in a lot of areas. I just feel that don't necessarily need to reinvent the wheel here, and I was only asking. My views are well known in this. Has a proposal been put forward, and as of yet nothing formal.
That's true. I don't want that to be misinterpreted in that we are having lots of engagement with the credit union sector around business model development, but in terms of a formal proposal for a public bank from the credit union sector, we haven't.
Okay. And then the final question on page 8 to Governor. In recent months, we have stepped out our work on mitigating the most material cliff edge risks of you said on mitigating the most material cliff edge risks of a hard Brexit. Can you define what you mean there?
Sure. Ed's led that work, so I'll turn to Ed.
So this is all in the, maybe the best way to describe this is to think about the conversation we've already had around thinking about the kind of macro issues, which has been a feature of our work for at least 3 years or more, the macro risks around Brexit, and that kind of funneling down to very specific contingency planning around what would happen in the event of a hard Brexit, no-deal Brexit, on the 29th of March or 12th of April, whenever it might take place, thinking about the interconnections between the Irish and the EU27 financial system and the UK financial system, how that plumbing works, specific concerns around liquidity management, kind of market dislocation, market shock, both for banks and for other entities. Really trying to understand the consumer protection risks that are there, for instance, in the likes of insurance, lots of insurance written from the UK, and also our engagement with regulated firms to make sure that they are doing all they need to do, not only to prepare themselves for a hard Brexit, but also thinking about...
The final question is, I know I have to go. No, it's not a final. It's one. Have you had engagement with the Bank of England, and are you satisfied that we're Brexit ready in the financial services sector?
So we have lots of engagement with the Bank of England, the Prudential Regulatory Authority, and the Financial Conduct Authority. Certainly weekly. I exchanged emails with the Deputy Governor there over just today and yesterday on specific matters associated with Brexit. We've worked very hard in the European setting to make sure that there is a good, strong memorandum of understanding that will allow us to continue to cooperate and work collectively to make sure that we're supervising and regulating these firms that operate on a cross-border basis post-Brexit. In terms of preparations, clearly, as the Governor has remarked on, a hard Brexit would be bumpy, it would be difficult, but our role, or certainly part of our role, is to make sure that the financial system isn't the cause of problems, that it's going to be there to continue to support customers, support businesses post a hard Brexit and all the difficulties that Ireland would suffer in that circumstance, rather than be the cause of problems as it has been in the past.
Okay, thanks, Senator O'Donnell. Senator Burke.
Thanks. Look, I'd like to welcome the delegation here as well, and I'd like to wish Mr. Lane the very best of luck in his new appointment. You'll be glad to know, Chairman, I'll be fairly brief. Just a number of questions. I'd like to ask, has the Central Bank done any work in relation to the price of houses? We have seen quite recently where there seems to be a decline now on the price of houses in Dublin. And have you any work done in relation to the cost of building a house as regards to the price of a house? Because some builders will tell you that it's not profitable for them to build houses at some of the prices they're getting outside of Dublin. So I just wondered, at the bank, any work done in relation to that?
So clearly, we look at house prices on an ongoing basis. As you know, house prices move around a lot more than cost of building. So there's all sorts of demand factors as income levels change, as population changes, as interest rates change, as rents change. So when we look at what's moving the price of houses, it's those kind of factors. Because remember, when we look at the price of houses, it's the price of houses that are built. So it's not getting to your question, which is, why aren't certain types of houses not built? So the house price issue is one issue. I think there's a different issue, which is considering the supply of housing and also the mix of housing. Is the mix of, say, starter homes outside of Dublin where it should be, compared to the mix within Dublin, big issues about apartments versus trophy homes, all of those issues. So I think that's a separate set of issues, because I think we have a good track on the price of houses, but that's a separate issue to the issue about why certain types of houses are not being built to the same degree as other types of houses. And that issue about affordability, this goes to the constraints on the construction sector. I would say there is a big increase. So I was looking this morning, and I think in 2019 compared to last year, we see about a 17% increase in construction, and we look also, given the kind of planning permissions and so on, another 13% next year. So there is a big increase going on. There's a big increase last year as well, but it's from a low base. The collapse in the housing market, construction was incredible. It was huge. It went from overbuilding to kind of near zero. And so now we're coming back this year to about 23,000 homes built this year. We think 27,000 next year, which is still below where it should be. So the construction sector is responding, but that takes time. And so this is why we're in this difficult situation of the mismatch. So many people either homeless, renting when they prefer to buy. When they do go to buy, the type of home they want is not available. So, I know it takes up a lot of the concerns of the Oireachtas, of the government, of us. But, I think it's going to take time to improve. I mean, there is a lot going on, but it's not something that's going to transform overnight.
In relation to the sale of loans by various banks over the last number of years, I have got quite a considerable amount of correspondence from people who have to vacate their homes, and they are just wonder how, I presume that they have got permission from the central bank in relation to the sale of the loans, but it would seem that the bank sells loans to a company like Cerebus or some other financial operator. They wouldn't seem to have any jurisdiction here in Ireland, as it were. They're not operating, we'll say, on a day-to-day basis, because they're getting the likes of other operators to operate for them on a day-to-day basis, like the likes of Capita. But then when a repossession comes along, it's the original bank that carries out the repossession. They obviously hold the deeds. So I was wondering, Governor, would you explain to us what the process is in relation to when the loans are sold? Then there's another company that operates on the day-to-day basis, but when there's an eviction or when the person has to vacate the home, this is to be, all this business is carried out by the original bank, or the original bank has to have the security. Do they not give that security or the deeds to the people that buy the loans?
So I think the way you describe it is not quite the setup. So maybe I'll turn to Derval on this.
So in terms of the system, and it is a little complicated and actually about to change again because of legislation enacted, as loan ownership might rest with an entity, and the framework that was put in place was that credit servicing firms deal with consumers, because we were at pains to make sure that consumers would always and only deal in their interactions in terms of any arrears or loan issues that they had, performing and loans that might be in arrears. We wanted to make sure that they always dealt with a regulated entity. And you might recall a lot of discussion here and I'm sure in other circles about the underlying loan owner not actually being subject to regulation. And because of that, new law has been passed recently by the Oireachtas that means that the underlying loan owners are now subject to regulation, and that's in a transition period. So if I just say in the future, all loan ownership, the entity who owns it will be subject to regulation. But as it stands, the system in place now is that a consumer might deal with a regulated entity. It's the law that they have to, so that all the protections of the Consumer Protection Code, the Code of Conduct on Mortgage Arrears, all that compliance, we can supervise it and make sure it's done properly and that they meet their obligations to the entity. But once a matter goes to court, it may very well be that the owner of legal title would have to be dealt with in the legal proceedings, and the loan ownership had previously been resting with the unregulated part of the entity. So the transfer of title could be that that was the issue you're talking about separately. But in the new system going forward, as I'm sure you're all aware, the new system is that the underlying loan owner has got to be regulated, and they're in a transition period right now. That transition period ends. They have to make an application by the 21st of April to do that. So that will no longer be the case. But that might be something to do with the legal system requiring the title in possession proceedings to be dealt with by the owner.
So the original bank who probably gave out the loan is holding the deed?
No. So the title, ownership is defined, I think, by the transfer of the title.
Sorry to is this the case where they're dealing with banks that have left the market, potentially?
No, so this is where loans have been bought by one of those vulture funds, and when the person has to vacate the house, they're dealing with the bank that gave them the original. The papers that are served on them is served by the bank that gave out the original loan.
So I'm just wondering, sorry, in terms of to follow on from Derval's articulation, whether that's a specific circumstance where it relates to a bank that's no longer authorised in the state.
No, the bank would be authorised in the state.
So it might be better to take this because of course, many different possibilities. I mean, because there's been so many different types of loan sale, so many different types of credit servicing arrangements where a bank may have contracted the servicing to someone else. So I think we better follow with you with the particular example you have, and then we can try and give you a more structured answer.
If you write to me about the particulars of that case, I'd be happy to look into it, because it sounds like it's particular to that
Well, I don't think it's particular to that example. I think it's the norm for most cases that it's the original bank that gave out the loan that it has to serve the papers and the person who's vacating the house on behalf of the people that have bought the loans.
I think we will come back to you on that one.
Okay. Thanks, Chairman.
Thanks, Senator Conlon Welsh.
Thank you, following on from that, is it not explicit in the contract that the lender shall remain responsible for all aspects relating to the loan? And would that not override any consideration if it's in the original contract? Under contract law, wouldn't that be the case?
It's very difficult to answer that question without any of the particular circumstances. You're asking quite specific legal questions of title, of property, of transfer. And to give you a fair and informed answer, I need a little more information than that to consider the particular proposition. So I'm very happy to come back to you. But these are technical legal points that one would properly, to give a fair and considered answer, need to have all of the information to inform the answer.
No, and I get that, but obviously in common with all of those, I mean, the contract is the basis of everything, really, the contract. And in your role as consumer protection is to protect that party, the consumer party, with the contract. And if the contract says that the lender is responsible for all administration of it, then surely that it's really kind of seems fairly simple to me.
I think most contracts have the option where the loan can be sold. So then the lender, who is the lender, will change with the loan sale, so that whoever's bought the loan will take on those responsibilities. So who fulfills the contract?
But it doesn't say that in the contract. If it doesn't say anything about being sold on or anything like that.
Well,
it just says
that. By and large, I think most contracts do have that issue that the loan can be sold, because clearly the loan cannot be sold if it's not allowed for by the contract. So the contracts do do allow for that.
There's an interaction of two systems here, which is the system of financial services regulation, which has a role to play, and then contract law, property law, and the role of the courts. And there's two big interactions here. Some of the issues that you refer to might be particular to the wording of a particular contract, and in general terms, you'd want to take both of the interactions into account in giving an answer. But if the contract is silent, there's other legal mechanisms that operate to give the answer. But
so the contract law doesn't supersede any other law, is that what you're saying?
They interact.
They interact, but it doesn't supersede.
And one would have to look at the circumstances. There's sometimes statutory law overrides the wording of a contract, and sometimes the contract has to be read pursuant to other factors. You'd need to have the factors to give a very definitive answer.
Well, maybe you can furnish for the committee here, because I think it's a very important point. You know, if it's explicit in a contract, such as this KBC contract, that the lender shall remain responsible for all aspects of the administration relating to the loans, then, which I think we need, as a committee here, we really need to know that information, if we could have that information.
Sure. I think it's best if we look at the contract you're looking at, and then we can see.
Well, it's in a lot of contracts. See, it's not just, and I think as Senator Burke was saying, it's not just in one contract. It's in a lot of contracts that you would be dealing with all of the time.
It's as Derval and the Governor have referred to, it's around, it's difficult to opine without looking at the contract, but I think my guess is that it would kind of rest on the definition of the lender. So it doesn't say the original lender, it says the lender there. As you've read it out, it talks about the lender.
Yes.
And so that lender could, as the Governor has described, be different from the originating lender. That's
no, the person has the contract at that point in time.
But there's also in those contracts, as the Governor's referred to, an ability to sell on the loan. I think. I mean, without looking at the specifics, I think that's probably where the interaction is.
Well, the lender is defined, obviously, as, say, if it's KBC Bank, is defined as a KBC Bank.
It's whoever. Again, I don't want to get into, because I'm not looking at the KBC contract, but in general, the consistency is the lender can change. So as a customer, you know that whoever is the lender is obliged to follow that. But that does not rule out the fact that the lender can change, because the original lender can sell the loan to someone else. So who is performing the function of the lender does not mean it's the original lender.
Yeah, but there isn't provision for that, and this is why I think that the central bank has a real, in the central bank's interpretation of all of this, I think there's a real, ambiguity there in terms of who the lender is, or who the lender is in the whole chain of if these loans are going to be sold on and sold on again. Surely everything has to come back to the original contract.
Again, I think it's better to
Could I just say that when a contract is entered into between a lender and a customer, the terms of those contracts remain certain, and any lender has got to stand in the shoes of those contract terms, because you can't have a unilateral variation of contract except by operation of law, some other kind of law that will interact. But it is permitted in law, in statutory law and other laws, for the lender to sell the title to that loan and pass it on to another entity, so that the lender can swap shoes with another who would step into that contract, but all of the terms and conditions of the contract would persist and pertain, and the new loan owner would be bound by those. That happens with an interaction of statutory property law, contract law, and, for example, securitisation and other areas of law. And it is allowed for a loan to be sold, and for a new loan owner to step into the shoes of that contract. But our role is to make sure that the protections of regulation stay in place, no matter who owns that loan, so that the consumer is fully protected. And I think in terms of contract law, a consumer is entitled to rely upon the terms and conditions and protections inside of the contract. But there can be a lot of complicated particular parts of law that come into play in that, as well as the actual precise written terms of the contract. I hope that's somewhat helpful.
It's clear as mud. Okay, I want to go on to the tracker situation. So you know the number of people now. You have identified the number of people, or a number of people who are responsible for the tracker scandal. Do you at this point in time?
I can't discuss any of the enforcement actions. It would prejudice the outcomes and actually serve as a way to make getting any kind of outcomes less likely.
But you know that there's a number. I'm not asking for details, but you know that.
What I'm saying is that the investigations are absolutely forensic and thorough. And from the get-go, the Governor and I have been really clear that we have a strategic commitment to individual culpability being part of our enforcement approach. So when the cases are under investigation, we look in a very detailed way about who was responsible as well as what was done. And where there's evidence to support individual accountability, we take those cases forward. And the previous enforcement record that the Central Bank has built up over time, I think, demonstrates our commitment to that. We've brought more than 120, I think, enforcement cases over time, with more than 70 million euros in fines levelled. And there's about 30 outcomes between disqualifications, prohibitions or refusals, suspensions against individuals that demonstrate that where we have the evidence of individuals needing to be prohibited or disqualified, we'll take those actions. And we bring that same commitment to the enforcement cases in the tracker mortgage examination. It's a key part of our regulatory approach.
Have you a time scale on that when you expect that we will know the results of that?
So the 6 cases are opened. They started at different times, and the information feeds that we're getting from them are coming from the supervisory work that we're doing in the examination line of work in the tracker mortgage work. So they're all on different timelines with different degrees of complexity and different issues in them. We'll expect some outcomes this year.
Some outcomes this year. I want to go back to when you were here, Governor Lane, at on the 18th of January. You talked about the prevailing rates at that time, and there was a lengthy discussion around it. And you said that you had got expert advice and that you were going to make that legal advice available to us. Has that been made available? That was around your interpretation of the construction of the contracts?
I mean, I think we've, I don't recall that particular exchange, but in general terms, I mean, we have our understanding of the prevailing rate issue. As Deborah said earlier on, with the AIB cohort, they were included in the examination. There was a payment made in recognition of the fact they should have been offered a tracker. But I recognise, many in that court would be dissatisfied about the tracker offer they received compared to what.
And I don't want to go over that again, but I just want to say, when it was put to you, that the central bank that it would be helpful if you and the central bank wrote to the committee setting out the assessment of the prevailing rate issue and the factors it took into account in arriving at the broad conclusion that the approach of the institutions was to interpret it, the prevailing rate. You actually said that would be probably more effective in a verbal two-way conversation on the issue. We can only give partial explanation, whereas if we lay out, and these are your own words, if we lay out explanation on paper, it can be studied by the committee. So did you lay out that explanation on committee to be studied, or on paper to be studied by the committee?
So, I mean, I think we'd have to check and follow up about whether, if that happened or not. But in terms of being able to explain, I'm happy to write you a letter. Sorry?
The Senator is reading from the transcript.
Yeah.
So in terms, as a follow-up, if we were remiss in that, we can follow up by explaining our approach to this. I think is okay. But Derval?
Yeah.
So, If something wasn't followed up, we apologise. After each appearance, we often receive correspondence setting out for us after a hearing the precise areas to which we should respond, and we endeavoured to do so comprehensively. I don't believe that request was outlined in correspondence to us, but we're very happy at a... No, I'm saying that it could be an oversight, and for which I apologise. And I'm very clear that the Central Bank would not publish our own internal legal advices. That would not be a course of action that we would take. That would be against our confidentiality obligations, where we can't talk about the particular issues affecting an individual firm. But I was very happy to answer detailed questioning on the prevailing rate issue previously here, where the issue was around the meaning of one of the terms in the contract around then prevailing rate. I recall the contract being read out to me here, and I discussed that. What I will say in terms of our view and our outcome on that particular case, the Central Bank has a very pro-consumer focus. We demonstrate that in terms of the numbers who have been included in the tracker mortgage examination. And when we see an issue like this, we recognise how important it is for people, and they would wish to be returned to a cheaper tracker rate. And we take a very robust view of the interpretation of all of the relevant factors, including the contract. And where we could take a pro-consumer view, we would do so. In this particular case, we took the strongest view we reasonably could, and we determined an approach on this one. And in terms of the AIB prevailing rate customers, I recognise that they would be disappointed because they haven't been returned to a cheaper tracker rate. But they were included in the examination and therefore got the benefit of the option to appeal or to exercise any of the other options available to them. And we took the strongest reasonable approach that we could, but we felt we couldn't challenge the interpretation of AIB further.
This really isn't good enough at all. This is such a serious issue that for the Central Bank to commit that they would outline on paper exactly what informed your decisions around this. And I do absolutely know that this will be tested in the courts. And what I'm concerned about, I suppose, Governor Lane, is that you will be gone, and I do wish you well with your new job. But for us as an Oireachtas Finance Committee, not to have that explanation laid out on paper, I think, is a serious matter.
I think that's a reasonable point to make. And again, if we were, because we do make an effort to follow up after these appearances, and I think it's straightforward for us to lay out at the level of generality our approach to this. So I think that's reasonable, and we can follow up.
Check the transcript, and if you respond.
So I think the distinction Dermot is making is there that
I know what you're saying, but I know as well that after each of these committees, the transcripts will be forensically examined by people within the Central Bank and within all of the other banks as to where we're going and what frame, the direction we're going, and what frames this. So I would ask, as a matter of urgency, it hasn't been done, if you could do what you committed to do on the 18th of January to help us in our work from here, because you talk all of the time about your consumer protection role, and it's a role we take very seriously here. I want to ask you in that regard, is it true that the AIB's independent redress panel is rejecting all cases around the prevailing rates, so people who are objecting to the way that they have been retrospectively interpreted?
I understand that a number of appeals have been made in the AIB hearing on that matter, and I understand that they have not succeeded in the appeal hearing. That is my understanding as well.
Do you know any of them that have been successful in appealing that?
On that particular point, my understanding is reflected as you have suggested.
Well, is it then that AIB are actually setting the narrative on such cases?
So what I'd like to say about the Appeals Tribunal, precisely because we knew it was really important for customers to have options in terms of inside the tracker mortgage examination and a right to appeal, we insisted on the appeals mechanisms existing and that they would be independent or have a majority of independent people and have consumer advocates included in those panels, so the credibility and the decision-making of the appeals are at arm's length to the lenders, and that they are led by independent people and in the majority of independent people, particularly having consumer advocates. So those appeals decisions are at arm's length from the central bank, at arm's length from the lenders, and that's important. And it's an important safeguard for people that they can go as one of the options available to them to an appeal panel where their decision can be listened to afresh with independent eyes. And that is a significant characteristic of those appeals panels.
Just remind me of the makeup of the independent appeals panels again. It just seems unusual that in terms of rejecting all cases, you know, in favour of the bank's interpretation, seems a bit...
Let me say more broadly, I think what we've seen in the aggregate is of the appeals across the whole system, of the appeal decisions that have been made, about half are in favour of the person making the appeal. So in the aggregate, across all of the cases, it's a 50-50 situation. So that's indicating that there's plenty of willingness by these appeals panels to increase awards. So that's the aggregate number. So, you know, it's not the case that there's some structural resistance in the design of this. So I view that as a success of this design, that so many people are receiving higher awards because the appeals mechanism is there to bring into account individual circumstances. Every family is different. When an appeal is brought, the person may be able to bring extra detail, either about how the original decisions were made, or about the damage they faced as a result of the handling of their individual situation. So the fact across the system, it's about half of those where the appeal decision is finalised has received an increased payment, is showing that the appeals mechanism...
But we're talking here specifically about the prevailing rates, and that's the one I'm really interested in. I mean, and if there's a blank... See, I'm trying to get at, if there's a blanket rejection of it, you've had your interpretation of it. So really, the central bank is standing over that interpretation. Right. So if that was to be tested in a court of law, the central bank are standing over it. You have had your own advice, and you're going to provide us with it. You see, there is the issue of the banks trying to apply respectively commercial common sense, retrospectively commercial common sense. So there is the whole issue there again of contract law.
So, I mean, again, remember with the examination, everyone involved always has these other options of going to the Ombudsman, of going to the courts. But you know, in how we address that, remember, as Derval said, the decision was that there was not a zero issue here. They were brought in. There was a kind of fixed amount of compensation for the fact they should have been offered a tracker, and then the right to appeal is there. But maybe Derval can also...
So I'm glad to be able to report that we wrote back to the Oireachtas on the 1st of May 2018, item 4 in that letter. We were requested to inform the committee of how the central bank assessed the prevailing rate issue, to include the factors the central bank took into account in concluding that the interpretation of prevailing rate as being the rate which applied at the time that a person came off the fixed rate, and we provided a response in that correspondence. So there was no oversight on anybody's part. So I'm glad to report that that is detailed in the letter of reply. Okay. From the
that tells us when you did it, not. But surely in contract law, it would be the case of when the contract was drawn up, regardless of whether. Of when it was drawn, of when the money was drawn down. Surely it should relate to the date of the original contract. See, you have the situation where you have, obviously, you have the only variable within the contract is the ECB rate. So the margin is the constant, and this is what I'm trying to get the rationale for assessing that.
I mean, I think this is, we've always been clear. I mean, there's been all sorts of tracker contracts, some with a fixed margin, others where the margin could change. And this goes back to this whole issue about the prevailing rate. And the prevailing rate at the time someone rolled off their fixed mortgage and was looking to return to a tracker at the prevailing rate at the time of roll-off. And that essentially is the difference in interpretation. But that's, we've, I say our assessment is that the rate at the time of roll-off, and if it's in the autumn of 08, early 09, at that point, trackers were not being offered. They should have been offered. So we're clear those customers should have been offered a tracker. Yeah, but the rate at which it was going to be offered, the assessment, was in excess of the variable rates at the time.
So does I just need to get this clear. Does the rate apply to when the contract was actually signed?
It depends very much on the particular contract and the wording, and one would have to read the wording of the terms and conditions as a whole and in particular, and you'll come up with a different answer depending on the different words of a contract. In the particular case that we're talking about, one of the key terms, there were a number of key clauses, but that had to be read in its totality. One of them was a phrase in that contract called the then prevailing rate. And the question arises, what does then mean, and the timing that it relates to, and the view that AIB took was that related to the timing that the customer rolled off a contract, and it was at that point in time what prevailing rate they would be offering, not at the prevailing rates at inception of the contract. And one has to look at these things in their totality, and the central bank's approach had to be, could we reasonably challenge that approach that AIB were taking in all the circumstances, taking all the contract terms into account, looking at that rate and looking at the actions. And the central bank took it as far as we felt we could from our perspective. But of course, there could be particular things that each individual might be able to say that we wouldn't know about, things that were done or said to them. And it was very important to offer customers the opportunity to avail of the options to them inside the tracker mortgage examination, for example, the appeal, and of course, any other options. But we were as robust as we could be in that particular case. And our track record demonstrates our robustness because of the numbers of customers who have been included in tracker mortgage examination. Because when we look at an issue, we don't just look at the contract. We look at the transparency requirements, we look at the factors that were pertaining at the time they entered into the contract and what their legitimate expectations would be in terms of all of those circumstances, and we look at what we see as a reasonable approach to that. And we have not been behind the curve in terms of challenging where we feel that there's a reasonable interpretation, and we're committed to that. But I do recognise that some customers will be disappointed in the outcome because there are people who would wish to have that cheaper tracker rate that don't have that, and I understand that some might be disappointed. But on their behalf, we have taken a robust approach and have ensured that where we could challenge, we have challenged, and where we reasonably can do so, we do.
So yeah, and I just want to finish this. So you agree with the then statement that applies to coming off the fixed mortgage and going on to the tracker, not to the original contract?
We weren't in a position where we could reasonably challenge the approach that AIB took on that, but we would support consumers' right to take their options where they feel that's right to do so for themselves.
I think it's important that the central bank do have a position on it. Do you know, where the bank acknowledges a failure, they don't acknowledge a breach of contract. Do you believe there was a breach of contract, a systemic breach of contract by the banks?
Some of the instances in the tracker mortgage examination will result from a breach of contract scenario, but some result from transparency requirements, the standards that we expect to be met, not being met, and so they can be different things. For example, some of the contracts just weren't clear and we expect the lenders to give the consumer the benefit of the doubt. That may not be a breach of contract, but it's important that customers are very clear about the expectations that they can have, and we're very strong with the lenders on that, and a significant number of the customers who have been included in tracker mortgage examination is precisely because we don't think that they were clear enough with their customers about what would happen throughout the course of the contract or various changes. And we have advocated very strongly for people and ensured that they have been included in the tracker mortgage examination redress programme because of that.
Do you think that the banks have tried to apply commercial common sense retrospectively in many of these cases?
So I'm not
Which
totally
obviously
sure,
goes against
in the sense of, where the contract is clear that the commitment is in relation to the pricing when the contract was signed, that's where the trackers are being returned to. Where it's in this alternative phrasing, where the case is being made, it's the pricing when the roll-off and the fix is there, then it's a different outcome. So it depends on the contract, but it's not the case. If it's clear that it's pricing at the time the contract was signed, then that's obviously those are much bigger compensation cases.
Yes.
So there's all sorts. The tracker examination has all sorts of contracts, all sorts of different issues, and this is why there isn't a single narrative here. There's a lot of different categories of customer here, and this is why the scale of awards are very different, depending on what the problem was. And that just reflects the fact that these are very dependent on the time, dependent on the bank, and so on.
And that's true, and that's why I believe that the two most important words going forward will be the and then. The then, and what that
Move on,
means.
Senator. Thank you. I have three more members to question. Do you want to continue or do you want to break?
Are we? I think we're okay.
You're okay? Deputy Murphy, so.
I'll take it easy.
What?
I'll try and...
Yeah. Well, if you want to break at any time, let me know. So, Deputy Murphy.
Thanks for the presentations. I'm sorry I was in the door whenever you originally spoke, but I did read them. Just a general question, first of all, in relation to the world economy. Do you think that that the prospects of the world economy entering into recession again are rising? Are you concerned by indicators like the inverted bond yield in the US on Friday, the German manufacturing figures, the slowdown generally, trade tensions and so on? Where would you place the kind of risks of entering a new recession, let's say in the course of the next year or something like that?
So I think it's not important to frame. I wouldn't characterise it as an issue about a recession versus not a recession, where a recession means typically going below zero. Because we're at a world level, the world's population is continuing to grow. So, often the IMF may have numbers like 3.5, 3.9, this kind of number. But the world economy needs to grow around that rate in order to avoid per capita reductions in income. Equally, in Europe, I can tell you what we're saying at the ECB is there is a significant reduction in growth this year. But we still think that there are reasons to believe that the second half of this year will be better. So one is the reduction last year was sufficiently unexpected that essentially inventories built up. There's overproduction, so there's inventories built up, which has meant the manufacturers might have slammed on the brakes a little bit to run down those inventories. So when inventories go back to normal, then production resumes. Two is the price of oil has come down. So last year was going up quite a bit, and then in the last months last year it started to come down. Price of oil is quite important across Europe because energy is such a big part of household expenditure and wider expenditure. So that's good news for Europe that the price of oil is coming down. And three is fiscal policy is loosening. So there's various plans this year to have a looser fiscal policy, and in some countries that's not yet kicked in. So there are some factors to believe that the second half of the year will look better than what's going on now. More broadly, globally, I'm sure you read the same material I do, which is there's concerns about, China is growing more slowly. That's always going to happen as they mature into a higher income economy and move away from manufacturing to services. And then the US, because the fiscal stimulus is fading, so the really high growth rates last year won't be repeated this year and definitely won't be repeated in 2020 under the current plans, where the fiscal policy is tapering. And in general, as the world economy, as the advanced economies go to lower unemployment rates, the room to grow is less. Essentially the last 10 years has been recovery from the crisis. It's easier to grow when you have spare resources that just need to be brought back into activity. When you hit unemployment in the US as 3-point-something, then it has to be productivity that takes the lead. And I think there's a wide range of views about the scope for that. So slowdown, yes. Slowdown, yes. The scale of the slowdown, I think, remains open to question. Tipping from there into outright recession, I think, is less likely. By the way, our own researchers did some work on this, and there's a recent publication from the Central Bank with a kind of recession probability calculator where it's kind of at normal levels. Recessions do happen. There isn't an unusually high read from that indicator, but it's not the case it's at a low level either. So, and I would say we do have to allow for the fact that we've had this really long expansion, that the risk of the occasional recession has to be part of how we run this economy in the coming years.
Thanks. And how would you respond to the argument that, given the nature of the growth that we've had, and given that an important factor in fueling it has been very cheap money, that if we were to enter a recession, that the capacity for, in particular, central banks to intervene in response to that is very sharply limited in quite a different way than 2007, 2008. Martin Wolf wrote in the Financial Times that a powerful implication is that room for a response to a recession will be limited by historical standards, especially in monetary policy. And this is quite striking. If the US Federal Reserve had to make a standard response to a significant recession, its short-term rates might need to be minus 2.5%. The European Central Bank and Bank of Japan would have to go further still. So, by virtue of the response of the institutions of world capitalism to the last recession, another global recession would come in the context of kind of having exhausted some of the toolkit for responding to a recession, particularly monetarily. I mean, I think it's also the case politically, but that's maybe less to do with your own.
Right. So, I mean, as you say, the historical pattern is there's a very significant move in monetary policy when recession hits. I would emphasise is 2008 was extremely atypical. It's so severe, and there was a clear set of imbalances in the run-up to that was going to make the recession especially deep and nasty. So the recessions we're talking about now that might happen in the coming years are not of that nature. The more typical recession in the US, for example, is a contraction of less than 1% of GDP, compared to the -5 that was seen in 08-09. So I think we have to be measured about this, about mild recessions. We don't have the imbalances from that period. On the other hand, it's going to be some mix of two factors. One is central banks. We've already done quite a bit in terms of finding unconventional ways to have accommodating monetary conditions. But at the ECB, every monetary policy meeting, when we release a statement, the final part of that statement is also indicating the responsibility on fiscal policy. And in 08-09, there was a coordinated fiscal response globally, and clearly in a severe recession situation, there has to be a fiscal response as well. This is one reason why, whether we here or elsewhere put so much emphasis, is in non-recessionary times, running fiscal policy prudently gives you the room to be aggressive in a downturn. So so we don't advocate surpluses for the sake of it. We advocate surpluses in the good years in order to allow significant deficits in the bad years. And what's interesting is the area of the world which is clearest about this is Scandinavia, because the Scandinavian countries are really want to protect public services, public spending, and therefore they run a very prudent fiscal policy. So in the mid-2000s, countries like Finland and Sweden had surpluses more of the order of 4 or 5 percentage points of GDP, which meant they could have a big fiscal response in the crisis and they could avoid the austerity that was so damaging. So they're interconnected. If you want to turn on the fiscal stimulus measures in a recession, you have to build it up in the good years.
Okay, let me move on to Brexit, but in a bit of a more medium to long-term way. The impact of Brexit as opposed to the immediate impact as well. I'll tell you in terms of the nature of the economy, and I think the danger that the Irish economy can become even more imbalanced, even more reliant on finance in the aftermath of Brexit, and whether you would agree that that is a danger here. So it was reported in the Financial Times that the Central Bank received around 100 applications from financial firms to move here, and as of January, 27 financial firms were definitely moving from London to Dublin. And obviously the government sees this as a big success. They're attracting firms, they're in competition with other European Union states in relation to that. But surely the danger here is that they're doubling down on a reliance on an outsized, substantially outsized financial sector, what's been referred to as Panama on the Liffey. And the dynamic of that, in terms of what Nick Shaxson has called the finance curse, which is like the oil curse, will be to drive deregulation, first of all, in that sector. That deregulation will then flow into the domestic sector, as happened in the run-up to 2007, 2008. And the result will be, a hollowed-out economy, a huge reliance on a sector of the economy which is not productive in Ireland, by virtue of the amount of money here, relatively speaking, the amount of jobs are not commensurate with, say, other parts of the economy. And there are real dangers in terms of an imbalance in the economy in that post-Brexit scenario in the medium term.
So I would share the analysis of that you have to think seriously about the side effects of an increase in any one sector. So one is finance, but there's other sectors which are really big here, which, I think, the general narrative of over-reliance on multinationals. So whether it's financial multinationals or non-financial, there are differences, there are some similarities. So in terms of crowding out other activities, in terms of over-concentration and so on, those are concerns that need to be addressed. And so some of the ways you would address those would be to make sure that there are supports, there are training and so on, to make sure that other sectors of the economy can operate. I would say here, it's a fundamental issue here. Well, let me make 2 points to why. One is we are a very open economy. So a lot of the jobs filling the multinational sector are coming not from calling on domestic workers, but there's also significant immigration with that. So that reduces, in one way, the crowding out risk. However, it does add to congestion. It adds congestion in housing, adds congestion in transport, in public services. So the government has to be very, I think, alive to recognising the implications of rapid expansion in any of these international sectors. I would say, and I'm currently in the middle of his latest book, by the way, that it's important to say, compared to them, the fact we now have this commitment, which is locked into banking through the single supervisory mechanism, but more broadly to saying, let's do financial supervision, let's do the rulemaking for financial supervision at a European level. It means the risk of being captured. So this idea that small countries can be captured by these interest groups, that's a real risk. And so having a coordinated approach where, and I can tell you with Brexit, I think Ed can follow up, is the amount of commitment across Europe to have what's called supervisory convergence. And Derval's seen it as well, that we're committed to make sure that the global firms are not playing one jurisdiction over another jurisdiction. So, I think a lot of lessons have been learned. We as regulators, we know we're here to protect the public interest. And this paradox, I think, if you like, that the internationalisation of finance has to be met with the internationalisation of regulation. I think it's part of that. But maybe, I don't know if you've your observations from what you've seen.
I completely agree. I agree with the point. I mean, it's a very interesting question, and I think it is worthy of thought and care. But on the regulatory side, not only in terms of our own work, but also that European and international dimension is critically important. And we were very active in the European for whether it was with the single supervisory mechanism or the European supervisory authorities to make sure that convergence, that consistency, that avoidance of a kind of a race to the bottom from a regulatory and a supervisory perspective was avoided, so that the decisions that have been made around firms coming here hasn't been made on the basis that they get a softer touch in Ireland than they do in another jurisdiction. It's based on multiple other factors. That, broadly speaking, and the IMF have published research on this, there are risks around the political economy of regulation, and going back to, I don't know, tulips and kind of many centuries around how that works through the cycle, and that's certainly something that I'm very alive to.
Just to follow up on that, because I think the point is that the lessons have been learnt, right? But obviously in the history of capitalism, the lessons have been learnt many times over, and the lessons always sometimes seem to get unlearned, and the mistakes are repeated. And certainly at the moment in the US, some of the harder, stricter regulation that was brought in the aftermath of the crisis is in the process of being reversed. We probably haven't seen the same effect of that in the European Union, but that can happen again. Pressure can come to bear, and that question, I take the point on the fact that the more it's at a European level, the more you're kind of safeguarded from those pressures. But it was one of the things that came out of the banking inquiry was that relationship between a deregulation in the IFSC and then washing back into the domestic economy. Just to quote Professor Gregory Connery, so the IFSC specialises in regulatory arbitrage and tax-type situations that are perhaps pushing the limits. That's partly what offshore centres do, but it's been done to excesses in some cases in the IFSC. Furthermore, that tendency or philosophy washed back to the domestic economy. The regulation of financial markets in domestic Ireland was hobbled by the very light touch approach that was one of the founding principles of the IFSC.
So maybe another big lesson that was learned globally is the risks associated with shadow banking. So the shadow banking was basically saying, let's do banking but in the shadows by, as you say, regulatory arbitrage. So I would say we've been very active. There's been a big global effort. So the Financial Stability Board had a big global effort to bring a lot of that out of the shadows. We can still talk about a lot of the features of that. And by the way, because there's so much here, but even at the Financial Stability Board, the decision now is, because so much is now out of the shadows, to make a clear description of non-bank financial intermediation and recognise it does need regulation. So in the same way here that we've talked so much about the transfer of loans to the investment funds, and when President Draghi was here a couple of months ago, he also acknowledged that a lot has been done, but more probably should be done about regulation of non-banks. But we, by the way, are at the Central Bank, I think, have taken a globally leading role in collecting information and publishing information about what's going on here. So we're committed to try and shine the spotlight on this sector. So we're showing what's going on in the special purpose vehicles, what's going on in the investment funds, what's the origin of the money? Where's the money going? So we've been publishing a lot, and maybe we could, I think it might be helpful for you to see some of this. So it might be to gather some of this, and then maybe I'll turn to, because Dermot's our lead at the European Securities and Markets Authority, to add to that.
So it's just important that we have an international facing dimension to our financial services sector here. That's quite considerable. We have a large funds industry that sells investment products to consumers in other jurisdictions, and that they can have trust and confidence in the strength of the firms and the products that they're buying, and the regulation that they're subject to is a really important factor, and that has to be sustainable for Ireland to be seen as a trusted regulatory authority. And since the crisis ensued, there has been a flotilla of strengthening of the regulatory frameworks through which a lot of the funds and other financial services entities operate, to make sure that we have far superior regulatory frameworks in place and access to information. And Ed referenced earlier our work in the international arena, but we take that very seriously, and we take part in the European supervisory authorities to make sure that we have a convergent approach with others. And in ESMA, we look very carefully at some of those issues in, for example, the funds area, to make sure that we have a quality approach that reflects exactly the European norms, so that people can have confidence in the approach of the fund sector when we're facing the international community, and we continue to do so. But a significant amount of regulation and law was brought into being after the crisis to strengthen that whole regulatory framework.
Thanks. Just to ask one final question, which is in some ways related, which is the question of the dangers of leveraged finance. So there's been a number of reports recently. The IMF warned that speculative excesses in some financial markets may be approaching a threatening level, for evidence to look no further than the 1.3 trillion global market for so-called leveraged loans. I think elsewhere the Bank of England has suggested that's an underestimate, and the ECB has also pointed to a significant relaxation of underwriting standards for US and European leveraged loans being observed in recent years. The likelihood of international contagion and system-wide spillovers is elevated in the context of a global search for yield. And the figures for European leveraged loans indicates that we're almost back to the levels of 2007. You have a steep decline, 2007, 8, 9, and then back up again. So what's the danger there, and what relevance does that have?
So I think the good news is, and as you indicated, so many different agencies are looking at this now. This is not a gigantic part of the whole financial system, but subprime wasn't either back in. So it's very important that we all study this. And the Financial Stability Board, I think, has just announced a new project on it. I think it's there's a lot of interesting material. I'll turn to Ed in a minute. But one basic point is some of the lessons have been learned. So, for example, one of the kind of vicious spiral dynamics in 2007 was various types of loans being funded very short term. But a lot of those leveraged loans, the funding line is significantly longer in maturity. So this issue about a panic leading to the death of these entities very quickly, that is not there. I think there's plenty of reasons for us to be looking at this because of the fact it's been growing quite a bit. But maybe Ed can add in.
So just one broad point, and then onto the specifics. So the broader point is that we are certainly, we in the bank, and also more broadly within the wider European regulatory system, are very focused on, well, what don't we know? What assumptions are we making, and what are the risks that are out there, and the risks that we are. Because next time, or as things emerge, different things will emerge to how they've emerged previously, and different mistakes we made. On the specifics, so actually consistent with that, as you've described and the Governor's described, there's a lot of attention being paid in this area. So the last time I was at the Supervisory Board of the SSM, there was a specific discussion around leveraged finance, following on from work that was done a year previously. looking across all the large European banks in terms of how active they are in this area, how much is staying on balance sheet, how much is being moved off balance sheet, what are the risks associated, what are the underwriting standards, and how we then can look at it more on both a thematic level across the system, and then what we might do at a more local level in terms of, from an Irish perspective, the extent that the banks operating here are active in this market. So it is most definitely something that we're attuned to and alive to, recognising all those warning signals that you referred to.
Thanks.
Thanks, definitely. Governor Lane, just in relation to the tracker issue, struggling to try and understand the paperwork of the bank and of all the banks. So my understanding is that on the very front page of the loan or the arrangement, there was to be the information on that date. So the information around the amount of the loan, the length of time of the loan, the number of repayments in the context of the loan, and then presumably the interest rate and the description of it might be there. In your forensic examination, you mentioned this earlier on, your forensic examination of the paperwork, is that not on every loan document? So that it's easily to pick up and say, well, actually that's a tracker, or that's not a tracker.
Unfortunately not. I mean, the tracker obviously is a term.
No, but apart from the tracker,
yeah.
The description of the loan. In other words, is there not that single document where you can read it in layman's language and understand the type of loan you have, the length of the loan, etc., etc., etc.? Is that not there on the document without having to forensically go through every single page of it?
So, I mean, unfortunately, as I say, these are legal contracts, and the wording there might be read by one person in a kind of straightforward fashion, and this is where the transparency issue comes in, is that you know, I would say that the interpretation of some of those terms, because with some of these trackers, it was not the case. They were saying it's the ECB rate plus a fixed margin. It was phrased like the then prevailing rate, as we talked about earlier on. So unfortunately, if it were as crystal clear as he said, don't think there would have been the issues we faced. It's complex contracts, ambiguously phrased contracts, non-transparency, and even over and above the contract, it's surrounding material like brochures, other things. But yes,
like,
so the contracts
I understand that, but I always presumed that there was that page where the customer would understand. So in other words, you cut away all the nonsense and the bump, and what the customer was getting on that day was set out for that customer. So therefore, you now looking at it in the context of what you're doing, which was never really envisaged, but anyway, it's happening, that regardless of what the finer detail of the package is, you know, in terms of the finer print, that at least on that page, there was everything.
Can I come in? So there's 2 million contracts were in issue in Tracker. Some of them...
No, sorry, I want you to deal with the question, but not specifically to do with Tracker, but to do with the information that the customer would see in the front page of their contract. Is there not a simplified version of all of that for the customer as part of the contract on that front page?
There is an approach to these where there's an information sheet on the front of the document that should have all the relevant information.
Perfect.
But unfortunately, sometimes that isn't written out as clearly as it could or should be. And that's been a feature that we have seen in the legals, if I call it that, in Tracker mortgage examination, and I think it's probably a little bit more widespread than Tracker, that not everything was crystal clear.
But did you find that page on every single document?
So
or
I should
contract?
be clear, the central bank has not gone out and read every single contract involved in the Tracker mortgage examination.
But you said you did a forensic examination. of the paperwork.
So, yes, we have, and we've constructed an approach where all of those things have been looked at in detail. We have sampled a lot of them. We've looked at customer journeys. The enforcement investigation is looking at other things.
Just stick with me on this. Did you find that on that paperwork there was this note to the front of the page, front of the document itself, that set out all of these details? Did they comply with that or did they not?
I haven't looked at every contract, and the central bank hasn't looked at every contract, so what I can say is some of the issues arose out of something not to do with the contract at all, and the issue hasn't arisen from that.
You're going off on a tangent,
So
Ms. Rowland. I want to restate this. On the front page, a notice in the form was to be set out, which gave all of those details that I'm after describing to you. And I'm asking you, in your examination, forget that it's a tracker, but you did the examination, therefore you would have seen these contracts, or someone would have seen them. Did you find this front page notice on every single contract?
The examination wouldn't have been focusing on that front page notice.
Why?
Because the examination would have focused on the issues relevant to tracker mortgage, just in tracker mortgage examination.
I'm not letting this go, I'm sorry. Because in legislation, in the Consumer Act of 1995, it states that an agreement for a housing loan shall contain on the front page a notice in the form set out in Part 2 of the third schedule of this bill. And when you go to Form 2, you look at the information on the date that the loan was given, the amount of credit, the period of the agreement, the number of repayments, the amount in euros of the cost of the loan, the total that would be repayable, the cost of credit, the APR, and so on and so on. That is in the legislation. So when I read that, I thought to myself, well, it can't be as an onerous a task as is being described to us, because you're getting this contract and you're seeing on the front page exactly what was described to the customer on that day. That's a fact. That's what it says here anyway. So if that front page is on every agreement, then that information jumps out at you.
So can I say that the question is framed in terms of the front page information. I think that's a requirement of the Consumer Credit Act 1995 to be set out in a particular way, and that should be present on the front of all contracts because it is the requirement. But in addition to that, one would always have to look at the information in the contract as well.
And I'm asking you, did you find that that notice in the form set out in legislation was there and available on top of every single contract that we were investigating?
I couldn't say.
But who could say? Can the central bank say?
Yeah, I think the way to phrase this is this has not been an issue that has been of concern to. I mean, if it's in the legislation, I mean, we don't have I can tell you, it's not come to my attention that there's been a systemic deviation from that.
Sorry?
The issue is, I mean, I've read some of these contracts. I've gone through contracts. So quite often the contract, and even I would bet on that first page, is the way the interest rate is laid out. It's not a fixed number. It's going to, and the question is, when you look at the phrasing of what the interest rate is going to be, it leads to some of these problems of ambiguity and so on. So when you say it's very simple, it doesn't, to express the interest rate, unless it's an absolutely plain vanilla type tracker where it's the ECB rate plus a fixed margin, but on other cases, or if the issue is what happens when you rotate from a fixed to a tracker, the problems, most trackers have been fine. Most trackers have been fine. They've been simple and they've been adhered to from day one. The problems typically emerge either when the contract has been not clear or there's been some event such as moving between a fix and a tracker. But I mean, We can follow up, but it's not my understanding there's a systemic deviation from legal obligations to write that.
This is what I have found.
Okay.
On the contracts that I have seen, I have on the front page of some of them, not all of them, the amount of credit advanced, the period of the agreement, the number of repayment instalments, the amount of each instalment, the total amount repayable, the cost of credit in real specific terms, the APR, and there's a description after that as to what it would be, the amount of endowment premium if it's applicable, the amount of mortgage protection if there's a premium, the effect on the amount of instalments of 1% and so on. This is specific to one particular case, and the annual percentage rate of charge. Now, if that's not on the contract, according to the legislation, a mortgage lender who is party to an agreement referred to in subsection 1 shall ensure that the agreement complies with that subsection. And the offences against that are set out thereafter. And then it says that the bank, the central bank, will enforce that. And what I'm saying to you is that I have now seen evidence where that was ignored. And it seems to me that it happened across the banks. And even if it didn't happen across the banks, it says here that if someone makes a complaint to the central bank, because the central bank is the one that provides oversight and enforcement of that act, that even on an individual complaint, you're supposed to act.
Okay, let me turn to Derek.
That's what I found. And then I said, you know, it must be difficult for a customer who is supposed to read the front page and understand it, to find, as you said, that there may be other specific detail hidden in the body of the agreement. I can't accept that, because that's not what the legislation says.
So I just want to say an entitlement to a tracker can arise from a lot of circumstances and has arisen from lots of circumstances, not on the face of the contract and not on the face of any other document representing the contract terms. Because what we recognised is that in complicated situations where people might have an expectation to get a tracker at a point in time from what was done or said, then they should have the benefit of that protection. So neither what is written down on that document or what is written down in a contract would have served the expectation for those customers. And that's what we mean when we talk about the transparency obligations, what advertisements might have said, or in an engagement with a member of staff from a bank, if they had given you an idea that you might get a tracker later. So when we were looking at the tracker issue, we looked at all of those kinds of things to inform us in terms of the factors that go into a customer journey at a point in time, what they could have reasonably understood to help them in their decision making at the time. So that would be things written on that front sheet, things written in the contract, and things done or said, advertisements or engagements with customers. We take all of those things into account. Now, separately, the content of the front cover sheets in terms of the key information that are present in a contract that have to be complied with for the Consumer Credit Act. Of course, if that gives rise to a tracker mortgage issue, we would look at that. But that information may not give rise to a tracker mortgage issue for the reasons that I have explained. And it's true, the key information for a customer should be in the front of that document. But it was and has been our experience that we had to go wider when we were looking at tracker to make sure that everyone was what we felt to be fairly dealt with.
But can I
it could be that there's an error in those documents.
That's my point.
Yes.
That if it's discovered that that page is either not there, does not comply properly with the legislation, then it's a breach of the law. And the central bank is meant to monitor that.
Yes.
So have you pursued convictions on the basis of that legislation?
No, the central bank hasn't pursued convictions on the basis of that. But, well, we would take an approach where we deal with a wide range of issues right across all the different areas that we supervise. We take robust supervisory action where we see issues arise that have to be dealt with, and we supplement our approach with robust enforcement actions across a variety of issues where we think that the enforcement actions will support credible deterrence. And I've already referenced some of the outcomes that we have taken. But where issues arise, we expect them to cease, and we take a whole range of actions within supervision that are needed in accordance with the magnitude of the issue.
That's fine. Well done. This is a breach. This is a breach of legislation. It's clear, not tracker, not anything else, and it's clear. You get a complaint. Do you pursue that complaint?
We'll take a wide variety of actions. When we get complaints from the public, we will definitely look at those, and we will deal with those issues in the course of supervision, and we have a wide range of options where we would pursue
but you've never pursued a case under the Consumer Act 1995 relative to the breach of that part of legislation as applied by the banks. Have you received complaints of that nature?
I certainly am aware that a single issue complaint came in of that nature, and I can confirm that we haven't taken a prosecution of that. But what we do is look at it right across all that we do.
Are you not obliged to?
Pardon?
Are you not obliged to under this Act?
We're absolutely obliged to look at the issues and take a range of actions up to and including enforcement actions depending on the gravity, the magnitude and the prevalence of the issue.
It tells you here that if they don't comply with that part of the legislation, that they're guilty of an offence. So you either are guilty of the offence or you are not. It's not a flexible thing.
I think we have a...
And it applies to other cases, by the way, it's not just one.
So let me say that regardless of what the issue is, we are always driven by our legal obligations. We have a very significant legal division which guides us as to what we should be doing under different circumstances. And absolutely we're driven by our legal obligations. But by and large, as Derval said, there's many ways to respond to violations of whatever regulation or law that we're charged with enforcing. And that's essentially what we do on a day-by-day basis. So we always do operate to conform to our legal responsibilities.
You see, people were not aware of that, this Act, in the context of mortgages and the requirement of the bank. So therefore, they may not have made the connection and may not have made the complaint to the central bank. But in this Act, and I want you to maybe confirm this to me in writing, in this Act, it sets out what has to be done very, very clearly. It sets out what the offence would be and the penalties. So you don't have flexibility in it. You have to abide by that Act, and even down to an individual case. And I'm applying, you say you have an individual case, fine. I'm applying this to what I have seen and what other financial advisors have seen. And it is now a case that there is considerable disquiet over the fact that this covering page was either never there, is missing, or didn't contain the information that legislation requires it to do. And the question I started out with was, in the context of your examination of these documents, because you say you had a forensic examination of the documents, did you find that throughout the banks, not just one bank? Did you find this as a feature of the documentation of the banks generally? And I want you to consider this, and maybe you might want to go away and examine it before you answer, because I have seen it, and I am deeply concerned that this information was not made available to people.
So I'm very happy to take any information that you have that you can give me on this.
No, I've given it to you now.
If you have any documents about the prevalence of this, or
no, but you've seen the documents,
more.
and I'm asking you to tell me the prevalence of it.
So I have information about this issue in a single circumstance. No. And I am happy to take any further information that you have, and definitely we can come back in writing, and I'll be happy to do so.
Well,
but
I'm giving you the information to the extent that I have been informed of breaches of that legislation throughout the banks. And I'm asking you, in the context of your examination of the tracker mortgage issue, where you would have been privy to seeing these agreements, is that correct or not?
That did not come up as a significant issue.
But you would have seen it. You would have seen it in the paperwork. Are you saying that you didn't see it at all?
What I can tell you is we're acutely aware of our responsibilities and what is contained in that Act. And it has been part of the track examination to bear in mind the intersection with that Act. That is true. But again, to repeat, if there are, whether it's from you or from others, if we receive extra and new information, we can respond to that.
No, well, I'm saying this to you again. You're the central bank. I'm just the chairman of this committee. I don't have a troop of people behind me advising me or assisting me. You have. And I'm just asking you the question, will you reflect on the report that says that this may be an issue for every single bank, in that they did not comply with this legislation and they did not provide the front page and notice in form set out by legislation? That's all I'm asking. And I'm asking you that for those who did examine the paperwork, was that a feature or not? It's a simple question, but don't put it back on me.
Okay, so we will come back to you on that.
Thanks. Senator Harker.
Thanks, Caleb. And thank you, Governor, for your opening presentation. It seems like a long time ago at this stage. Obviously, congratulations on your appointment. It reflects obviously very well on you, but I think on the country we'll all bask in some reflected glory, and I wish you well in that role. And maybe in connection with that, tomorrow in the Shannon we have the Land and Conveyancing Law Reform Amendment Bill 2019, which is a bill put forward by the Minister Boxer Moran. I think the Sunday Business Post alluded at the weekend that your new, I suppose, employer or boss, Mario Draghi, is not very keen on this, and there was some ECB opinion on it. What are your thoughts on that particular?
So I would share the concerns expressed in the opinion of the ECB, that this would give rise to a lot of new issues in relation to how any troubled mortgage would be handled. Because a lot of the specifications in the bill would give rise to a lot of, I think, contestation, in terms of a court process. I mean, it's basically asking the court to do a lot of work in terms of bringing in all sorts of extra information into how it should assess whether repossession orders should be granted. But I mean, I think the ECB opinion is pretty comprehensive in laying out all of the possible downsides to that approach. So we would share those concerns.
Okay, I mean, it's effectively being brought forward as government legislation.
I appreciate that, but I mean, regardless of who brings forward, we have to look at it. Mm-hmm. And the ECB opinion we would share.
Okay, thank you for that. In terms of, and obviously a lot of points have been covered, and I'm going to try not to be repetitive. I'm not sure anybody made reference to the limits or the in terms of house prices and mortgages and so on. Obviously there are mixed views on that. Some people would argue certainly that it's suppressing prices and keeping a lid on prices. Others would say that it's not allowing people who want to be able to buy to get on the market at all, because the prices are not in their salary by 3.5, whatever it is, will never get to anywhere near the price they want to buy. I personally think it probably is keeping prices down, and that's not a bad thing for anyone certainly trying to buy. What are your thoughts? I mean, they're your rules, but...
Yeah, so I think you've identified some of the issues there. So clearly we have two sets of rules. One is the loan-to-income ceiling, and then the loan-to-value ratios. And as you say, what's really happened, I think, over the last year or so, is the loan-to-income ceiling has started to bite. You know, that essentially someone may have a deposit, but the 3.5 times income is limiting their ability. Now, one thing to say is we recognise that kind of ceiling should have exceptions to it, because you might be, for example, if you're younger, you're starting off in your career and so on, you can make the case, well, my income 5 or 10 years from now is going to be higher than today, so the 3.5 times my current income, you know, maybe I can afford more than that. That's reasonable, and that's why we do have the system of allowances. I do think, as you say, that in the end, behind the loan-to-income, which is an anchor of the system, is to avoid a situation which is what we had before, which is house prices depart from income, where you had in the mid-2000s, the ratio of house prices to income really climbed a lot higher than that. So the 3.5, by the way, was an average over a long period of time of what the historical relationship between mortgages and incomes were. So it is something that, you know, it is biting. We do see that, but that's maybe the point. The point is to make sure that house prices don't go too far above incomes. But let me qualify that by saying, of course, this is only in relation to those who have the income levels to be competing for the house prices we're seeing. It is not a commentary on the fact there's an affordability issue here, which is for many people on middle or lower incomes, they don't have houses to buy in the range that they could afford. So, you know, I would share, I think, with the whole system a concern about the availability of affordable housing, and as you know, that's going to be some mix of more social housing through different channels, and as the amount of house building increasing, I would hope that there's more houses being built in that category of satisfying the starter home for regular people community. Okay. So there's more houses being built this year than last year, and there's more coming for next year. But I think that affordability issue, I think, is a concern. The fact that house prices are stabilising or coming down a bit because of the rules, I think that's just showing the rules have an impact. On
a related point, there are a lot of people who are paying very significant amounts of money in rent at the moment, and in fact, if they were able to get on a ladder,
I know.
They would be paying far less. And just trying to tease out the point, is there any way that somebody who's paid 4, 5, 6 years worth of rent, that there's some way that the banks or the central bank would allow the banks to recognise that these people have been paying out regularly, consistently, 2.5 grand a month in rent? It may be the case that their mortgage might only be 1,200 or 1,500, a lot less. There doesn't seem to be a mechanism at the moment to give recognition of, they can't save for deposit because they're paying so much in rent. It's very difficult to get a deposit. I don't want people to be over indebted. I don't want people to be in situations where they're going to lose their homes. But is there a way or a mechanism that you can see of giving people some recognition for the fact that these people have set aside money every month for their rent? If that money was instead being directed into a mortgage, they would be well able to service a mortgage.
I think you're bringing together different elements of this difficult situation. At the level of showing a consistent track record of paying significant rent, you know, I think our view would be this is obviously something the bank should be looking at in terms of assessing the capacity of that individual or couple to pay a mortgage. Absolutely. But then the question is, should the rules be different for that category? And that's where we would say no, that it's still important to have a deposit, because of the fact it protects the individual from negative equity risk. So the deposit is needed. And then second, in terms of the loan-to-income issue, is we still think it's necessary to have a relationship between the loan and income levels, because we know from historical experience when loans are too high relative to incomes, today, the next 2 years, the next 5 years, it might be cheaper than paying the rent. The mortgage may be cheaper than the rent, but the risk in a downturn where someone may see a loss of income, in a downturn where the loss of employment is a bigger probability, it's just, this goes back to our data analysis behind the decisions, is we know loan by loan, experience by experience, that the loan to income ratio has been an important factor in whether someone ends up in arrears and with a difficult situation. So it's a difficult situation. The key is more houses being built, and in turn the price of housing coming down, so that the rules that we think are important can be met while still delivering what people need in terms of their housing needs.
Okay. On that point, in terms of changes in circumstances, downturns in the economy and so on, and we did have a chief executive, I think it was KBC, who said we were closer, his view was we were closer to the next recession than we are to the last one. And I heard your point earlier in terms of maybe not recession, but maybe a plateauing or certainly a decrease in the rate of growth, if you like. The Minister for Finance has been relatively fortunate in the amount of corporation tax. I think it's fair to say that has been coming in the last number of years. Huge increases, unpredicted, unexpected, I think, by anybody. Also, he's been quite fortunate, I think, in terms of the interest rate environment and servicing the national debt. An argument about FDI might be the only way of dealing with having a small number of large companies is to get more of them. An argument that so we're less dependent on any one of them. But we are very exposed to, I suppose, at least 10, probably more than 10, but definitely 10 who are contributing half the corporation tax or the FDI corporation tax, along with very low interest rates. Where, in terms of your leaving this jurisdiction, you're heading off to the ECB. There are challenges there in terms of both interest rates being as low as they are and what they may go to in the future, and FDI. What would your parting thoughts be?
So I'm going to return to this. So today won't be my last word on this. So I'm definitely intending to take this up in a speech or a paper in the coming weeks, because I think exactly this is a very important issue, because it's a separate issue to the risk of recession. I mean, the world can slow down and so on. And for that reason, we, as I indicated in the opening statement, we did turn on this extra capital buffer called the counter-cyclical capital buffer. That's recognising that when the economy has advanced, where we have unemployment around 5% now, it's much more cyclically advanced than it was when unemployment was 15. So there's that cyclical risk, which is normal up and down economics. The big issue, which you've indicated, is Ireland also faces structural risk. The structure of the economy with this dependence on multinationals, which in many ways has delivered a lot, but it's risky. There's a structural risk there. And then second, with the interest rate environment, there's a cyclical component to interest rates, but there's a big long-term issue about, if you open any economics journal, it's about the interest rates have also come down on a long-term basis. And the question is whether those corporation tax revenues will remain high for a long time, whether interest rates will remain low for a long time, regardless of what's happening in terms of the short-term business cycle. And so when you have those structural risks, to me, and my deputy Sharon Donnery a few weeks ago made a speech along the same lines, it means for us, this is why we do think that the system needs high capital buffers. We do think we need these robust mortgage rules. And we do say, as we say all the time, that if the government wants the ability to run a relaxed fiscal policy in the next downturn, which is important, it needs to build up the surpluses, going above zero. So getting to zero, much better than not getting to zero, but going into significant surplus if conditions are good. will give the government more room in the next downturn to avoid austerity, to increase spending and maintain spending in a downturn, which is very important.
Okay, thank you on that. In terms of the tracker mortgage, the 665 million that's been paid out, is there a breakdown of redress versus compensation? Because, you know, people have said it's cost the banks X. Yeah, effectively, we're giving back the people the money that the bank should never have had. The banks, not you, but the banks are giving back money they should never have had. It's their own money.
Yeah,
and
I think that's an overhead cost. Sure, we do have the.
I may not have it precisely to hand today, but we do have it, and we certainly will publish that in our final report. It's information we have given out before, and we anticipate in the final report making as much information as possible available about the tracker mortgage examination from a number of different points of view, that being one of them.
I mean, I think I'd like...
Let me just say also, just a reminder, that our focus so far has been on returning the money that was taken from the customer, plus an element of compensation. But of course, through our enforcement actions, if these enforcement actions end up in conclusions that there needs to be a significant fine on these banks, that remains to be determined in the future.
I could give you, it may not be precisely up to date, but roughly of the sum that we've told you to date, about 76% of that is redress and about 21% of that is in compensation. About 3% is the independent advice element to it. So that's where we are at the moment. That slightly changes over time, but that's probably representative.
I think it would be useful in the final report that we would see the cost the banks incurred in having to employ all the people to sort out their own mess, plus obviously the redress, the total of redress, the total of compensation, and then ultimately there'll obviously be fines and enforcement and so on. And obviously that's, I'm assuming that's ongoing, so you can't overly comment on the enforcement actions. But I think most people would want to. A lot of people still wonder how every single bank managed to make the same mistakes in the same way, independently of each other. And I think it stretches credibility to imagine that there wasn't somebody somewhere talking to each other, because they all managed to do the same thing in the same way at the same time to their own customers, and it doesn't help. And on that basis, you know, the culture of banking, which we've discussed in the last number of weeks here, has been talked about. What are your thoughts on where banking culture has come from, has got to, and where it needs to go?
Sure. So I think I'll ask both Dermot and Ed to comment on this. I mean, the culture work we've done, I think last year was a very important piece of work, but there's an ongoing focus. So this is not just we'll write a report and move on. It's an ongoing focus on our supervisory work. But maybe Ed first, and then.
Do you want to cover the culture report?
I could do a little. Yeah. So I think the provisions that the banks have made to date on the tracker mortgage examination are in the region of €1 billion. And that includes the redress and compensation that they're paying to their customers, quite rightly, as well as the costs, because they had to dedicate a lot of resource to getting external support and assistance in. So that's one question. In terms of the culture of the banks, you'll know that we wrote a culture report last year, and we demanded of the banks that they give us a credible plan about addressing the cultural deficits that we saw. We've been particularly focused on risk. Ed will speak a little bit to the wider risk considerations, perhaps, because it's really important, but they're risks that they pose to their consumers and their consumer culture and attitudes. We actually went into the bank boards to discuss with them our expectations and to get a feel for them, their views, and how committed we thought they actually were to truly addressing this. Culture is not something that could be changed overnight. I heard a wonderful phrase that it's a lifestyle change rather than a New Year's Eve resolution. So if you're truly committed to changing the culture, there has to be a very serious programme over the years on the key areas of focus. And the findings that we had was that they had only newly developed a true consumer focus, and there were significant deficits in some of their leadership and their degree of optimism with respect to the fact that they come through a crisis, so they had perhaps an unrealistic view of what they were facing into in the future. We put the expert team back together again more recently. Our Dutch colleagues, who are world leaders in cultural assessment, came back to work with our prudential and conduct colleagues, who got together to look at the plans that they submitted to us about how they were going to go and do this, and we've evaluated those plans. Some we're actually very pleased with. We think that if they implement with true vigour those proposals, that would be a good outcome. Some we were pretty disappointed with. We thought they reflected the optimism, that they lacked the detail that we expect to see. But going forward, from both a prudential and a conduct perspective, this is a key priority for us. We'll be meeting with the CEOs of the banks again to give them our feedback on the quality of those plans. And as we roll out the different parts of our supervisory exercises, we'll be looking at what we think to be the key transmission points for cultural risk for consumers, such as the sales channels, the incentives. And when we go in and look at products and we demand that they can demonstrate to us the groups that they should be sold to, for whom they're suitable, for whom they should confer a benefit, and we'll check that against who in fact they do sell to. And that should tell us all we need to know about a consumer-focused culture, because customers should be able to get an appreciable benefit from the products that they're buying in the medium and the long term. So we want to see that kind of approach. So we have strengthened our approach to consumer protection. We're getting more firm, specific, but it's a continuous part of what we expect. But in the end, culture is something for the firms to change. Culture is the responsibility of the board to lead out on, and we need to see that transmitted through the pressed middle, right through to the frontline staff, who need to be supported by their leaders in delivering that consumer focus that we expect to see. But this is a journey that we will need to see their demonstrable commitment over years, and not a flash in the pan that they can talk about last year and it will go away, and we'll be demanding that from them.
Okay. Just to add a couple of additional thoughts on it. So, at least partly connected with your comment, if you put very similar people in similar circumstances, ask them to make similar decisions, then you're likely to get similar outcomes. And we've been focused both on culture but also on diversity for a number of years for that very reason. We have, in addition, or as part of the responses to the culture work and the plans around culture, we've also required the banks to come back to us in terms of what they're doing to enhance diversity, not just at the board level, but at the executive and the layers below that. And that, again, takes time. We can see that there are some incremental improvements, particularly across the financial system, but in banking in particular. And you'll see when you have the CEOs in, you'll see that there are different faces and a bit more diversity in terms of who you're talking to. But if you go to those that are leading the revenue generation parts of their businesses, the CFOs, so the chief financial officers, those that are kind of really driving the business forward, then typically you'll see very similar people there. And so we are continuing to drive to kind of significantly enhance the level of diversity in financial institutions, so that we do get people with different views and avoid groupthink. If we're going to get real cultural change, if we're going to see cultural change, then the things that the banks and other institutions espouse around being customer-centric, being customer-focused, need to come through and be demonstrated in decision-making, including about the topics we've discussed around front book and back book pricing on mortgage loans. And so that's something I think you could be very usefully discussing with them when they come in.
Just in terms of, and thank you for the response on that, I was at the Whitaker lecture last week. It was about kind of the future of money and payments and so on. It was a very interesting lecture and quite thought-provoking. But you are the Central Bank of Ireland. You have the mint up in Sandyford producing. I think it's still going to be producing coin but not notes, or vice versa. Which is going, notes or coins?
The production of notes is reaching its conclusion now.
But coins will still be produced.
Well, yeah, because remember, coins obviously, the coins of the realm, there's the Irish symbols on them. Yeah. So the final pressing is here. Yeah.
So just in terms of the future of money, I mean, we see statistics about we have banks that are they're branchless, they're in the cloud, they're new apps and so on where people can pay for things. There's all kinds of different ways in terms of people are tapping it a lot more. They're not using cash the way they were. You are the Central Bank of Ireland, you are the Governor of the Central Bank. Where do you see this going, and how do you see us bringing, or society bringing, people who are not that comfortable with technology, not that comfortable with debit cards and credit cards, or even that trusting of the banks for lots of reasons, some of which are very justified. It probably doesn't make sense for people to be storing it under the bed. It probably doesn't make sense for vans and to be army escorted out of Sandyford at the end of every month, going to ATMs and walls that are then dragged out at 3 o'clock in the morning by diggers and so on. Cash is going to be, I think, less influential than it was. Where do you see that going?
So I think we are really in an area where there's a lot of different possible futures. And some of that will be technologically driven, about what people want, what they find convenient, but there will be a role for policy. You may read in certain cities, for example in the US, they're insisting that shops do take cash. Because for a shop, obviously, cash is increasingly a security risk. And if you can get everyone to say that we insist you pay by tap, that may make sense for the individual shopkeeper, but as you say, it may exclude some people. So I do think there's we would, I think, have an internal desire that this question becomes more of a national question again. That there's before the crisis, there was some advancement in developing financial literacy, financial capability at a national systemic level. Then we all went into crisis fighting mode, and that's fallen away. So I do think the future of cash, the future of payments, the education needed for everyone to respond and adjust to this world is a societal issue. It's broader than just our regulatory framework. I would say that it's possible maybe to exaggerate the speed at which cash is disappearing. By and large, across Europe, cash is still continuing to grow. But of course, the nature of basic payments, you're tapping more frequently and so on. But I would say our role as a central bank is to be ready for all of it, to be responsive, to recognise the reality of what people want. Obviously, we have a particular role in relation to money, where of course money is not just currency, it's also the what's in your bank account. So it's I think we'll see what happens into the future. But by the way, I think a fundamental point is we are insistent that all entities who have that relationship with the customer should be regulated. So the idea there's a wild west of unregulated fintech or something. If they're going to deal with customers, they should face the same regulatory protections. I mean, we have a good consumer protection framework. It should be available no matter whether it's a bank, a tech company, a new startup, whoever. And what we've seen elsewhere around the world is underinvestment in meeting regulatory requirements by some of the fintech firms. So absolutely here in Europe, here in Ireland, we have to make sure that no matter what kind of new entrant arrives, they deliver for consumers. So we're neutral in the sense of let's see what happens. I do think there's a role for legislature and Oireachtas in framing what's permitted and what's not permitted. But within that, we would say we know what consumer protection looks like. Okay. We know what financial stability looks like. And we're not here to protect the incumbent banks. If they are blown away by new entrants, that's just a reality. But what's important is to maintain a stable system and a system that protects consumers.
Okay, just a final point. I would hope that you could get in the NPLs. I mean, it's a 79% decrease, 67 billion of a decrease in NPLs since the height. It's referenced in your speech. I don't want an analysis of it now, but I would like to see how that reduction happened, Was it to vulture funds? Was it write-offs? Was it restructurings and so on? It's a complicated bit of work, and I wouldn't expect it to be done in 5 minutes, but I would like to see
we would have that
breakdown.
So we can certainly follow up.
But I would say, even though, of course, the loan sales have been very important in the last year or two, it's very important to emphasise Ireland has really been a leader through the CCMA to encourage restructuring. So many mortgages have been restructured. That has been a big success, and it has to explain why repossession rates here have been, in an international context, quite low.
And sorry, just to be clear on that number, is the number you quote is non-performing loans in aggregate, which would include commercial, SME, and mortgage loans. That's not. I'm just
good from your speech. So there were the figures that were in the speech. And just finally, I suppose you're leaving where I suppose your role. You've done, I think, most people would argue, a pretty good job. But where do you feel you've failed or not achieved what you would have liked to achieve? And I suppose, in terms of the banking sector in Ireland, what's the greatest level of risk that's left?
So I think, to be honest, our strategic plan signals the way forward for the next number of years. Now, I do think, and maybe because I've been involved in designing the strategic plan, it's basically to continue to work and move forward in the same direction of travel. So we do think the central bank should be in a phase of consolidation and continuity, that the direction largely inherited from my predecessor and largely in line with broader European trends. But as we were talking about earlier on, I do think we need to do more in terms of dealing with these structural risks, not the cyclical risks, the structural risks. I think it's very important, as Dermot said, that our approach to consumer protection adds this extra layer of looking closely, firm by firm, about what's going on. So rather than just writing codes, rather than just being reactive, rather than just focusing on is the information clear or not, asking these banks in a challenging way, do they have the consumer central in their focus? Is there consistency between what they're planning in terms of new products, new sales strategies? Is that consistent with what we expect? So, I mean, I think that line of travel is there. I think the reality is whoever comes in, Brexit is not just an issue about what happens in these weeks. It's going to be a long-term issue about the separation of the UK from the European Union. And let me say finally, maybe on organisational capability. As you know, the central bank failed before the crisis, and there's been a big rebuilding effort. And it's very important that a lot has been done in terms of expanding the staff. You can't have an understaffed central bank. Improving the IT, improving the facilities. But that's ongoing. I mean, it's an ongoing issue to make sure that the organisation is excellent, that it's up to the job, and that's vital, that it's a well-run, capable organisation.
Thank you.
Thank you, Chairman.
Deputy Doherty, you had indicated there.
Yeah, thank you. Just a couple of questions here. I'll try and go through them as quickly as possible. In relation to individual accountability, and I understand, Ms Rowland, the investigations are ongoing and have been a very strong advocate in relation to individual accountability. But for Governor Lane probably new exit in the job in the next number of weeks. Is there anything that we as a committee or we as an Oireachtas should be doing that would ensure that if there was another scandal of the nature of the tracker mortgage or indeed the banking crash, that we wouldn't have to, that it would be clearer to hold individuals to account beyond what was recommended in relation to the British model being adopted here in Ireland? Is there surely that there's other measures that we need to take in place? Like it's raised with me consistently, and it's an issue that really bugs a lot of ordinary people. That you don't have your television licence, you're up in front of the courts. Whereas you're a high financier. You're involved in a situation where, 665 million has to be given back to 40,000 customers, and a couple of years in, we don't even know if an individual is going to be held to account or not. So, I understand that the rules that you are having to deal with are the rules, and I've always been of the view that the problem is that as legislators we haven't brought in rules that make it clear-cut that if you are involved in this type of activity that you can be prosecuted a lot easier. So is there something that the Central Bank could provide to this committee, or do you believe that the legislative framework that you operate under is robust enough?
So we have made specific proposals to the Law Reform Commission, and it is part of the planned Central Bank bill, I believe, to move forward. Brexit is interfering with the timeline, I think. But absolutely, we do. But Derval's area has been leading on the details on this.
So we've made a lot of the proposals that we think would be really valuable in the context of the Law Reform Commission, and we took the opportunity to repeat them more recently in the Culture Report. And I know there's going to be a hearing about this in a couple of weeks, I think, on individual accountability, maybe on the 18th of April. There's one due. Something that I think is really important. We absolutely support the effectiveness of a white-collar crime approach in this jurisdiction. We made a proposal, but it's about the capability and the resourcing and the staff to deploy. The capability is a really significant component. As far back as the time that Matthew Elderfield was coming in here talking to you about a review, he talked about people, powers, process, because you have got to have law, but you have to have the investigative ability and the technology and the skill sets to do this very detailed work. In our context, I think it's really important that in terms of the enforcement powers that we have, the administrative sanctions procedure, in regulatory worlds, that's a really key tool, and being able to effectively break the link between participation and proving the allegations against the firm will absolutely strengthen that as a toolkit, and it's something that we've asked for, and I absolutely want to see us get to strengthen that approach, together with the individual accountability regime that we have suggested. This is at the vanguard of the approach. The UK have this regime in place, but other jurisdictions, this is leading edge, and other jurisdictions are moving in this area. We're a leader in Europe in this context. The Australians have had a horrific set of scandals, and they're looking at a thing that I think they're calling it the bear regime. Singapore and Hong Kong are moving in this direction. It's absolutely the right place to go, and the effectiveness of the legislative regime that we get will allow us then to work it well and bring it in. So they're the areas of focus for us.
Okay, it's okay. Well, look, we've been waiting a long time for action to follow from your recommendations. What is it? Year and a half, nearly 2 years this year from the Law Reform Commission's submission, was it?
I don't have the date of the Law Reform Commission.
And we still don't have you to cite. I think it speaks volumes itself in terms of priorities. But I've said this before, but I think that, I know that the Central Bank liaises with the government minister in relation to changes, whether they're regulatory changes or legal changes that need. But I also think that it would be appropriate to inform the committee if you believe that there is areas that need to be strengthened as well. In relation to just on the topic of Brexit, I know Kieran was asking the question in relation to the sanctioning you mentioned about the two banks, Barclays and Bank of America, which are obviously now located here and one up and running. How many applications have you received in total for authorisation? How many are at hand? I know 2 have been authorised, but is there a pipeline of applications? And my understanding is we're losing out in the context of Brexit, if you can actually gain in Brexit, but obviously you can't. But in terms of Brexit and financial services, we're losing out mainly to France and Paris, and there's many issues and reasons, accommodation. And
let me make a couple of observations and then turn to or maybe about Ed and Derval, who are responsible for different authorisation processes. What we're seeing for now is not necessarily the end of this, because for now, firms have to have a contingency plan in place. So by and large, one basic element is a very important influence on where they're going is where they already are, because it's a lot easier to expand or think about a location where you already have some knowledge. So that's benefited us because we've had plenty of firms here already. So that's one point. The second point is this will be dynamic because the way financial systems work is they tend to cluster. But the clustering will depend on a particular line of activity. So Paris has, I think, quite a lot of trading floors. There's a kind of a matching there with the skills in Paris. We will have, I think, a lot of asset managers, we'll have a risk and compliance type functions. So the nature, because we have a single financial system in Europe, it does mean you can have this kind of different clusters in different cities. And then Frankfurt would also have a cluster of banks. But there could be a round two, because there could be a round two, which is, well, initially we went to where is most convenient. But now when we look at it, we think this location or that location is actually a better long-term home. So I don't think it's just a question of what's happening this year or next year, but maybe both of you can come in.
So, just to again supplement that, so there's well over 100 applications, either for new licences or extensions to existing ones. But that's a slightly misleading. I mean, that's a relatively meaningless number in some respects, because at one end you have the likes of the Barclays and the Bank of Americas, and at the other end you have a small investment firm or a payments institution that would have a very low impact, very low levels of employment. So that's the full spectrum. And what we've made sure that we're doing is we're applying a rigorous, robust, but transparent and predictable authorisation process that respects and is consistent with our role as gatekeepers to make sure that we're protecting financial stability and consumers both here and from a wider European perspective. We touched on it a little earlier. From the very start of this kind of trend, we've engaged very effectively in the various European forums. So that's banking, asset management, investment firms, and so on, to make sure that the regulatory and the supervisory approach is consistent across jurisdictions, so that the firms that are making choices to say, well, okay, we're going to go to Paris, not Dublin, or we're going to Frankfurt, not Paris, are decisions that are based on other factors and not being based on, well, we get a lighter touch or a softer touch in a certain jurisdiction. Now, there are one or two isolated instances of that, perhaps at the very start, but the work that we really did push in the European fora and then was taken up by other competent authorities really has focused on that kind of making sure that we continue to converge regulatory standards and continue to have a kind of robust and consistent approach.
On applications for new authorisations, and if we look at new as opposed to just the renewals, if you were to categorise that portion of them into significant players, how many are we looking at? How many significant firms are looking for new authorisation from the central bank?
Sorry, I mean that all depends on what you mean by significant. But like we see very material. I mean, you'd be well aware of the two very material banks. They are extensions. Yeah. We also see a couple more extensions of banking business in the state that are in train. Some of that may not come into the public domain quite so much. We've seen quite a lot of activity in the insurance market. That's both to deal with those firms that have been writing fairly significant business from the UK into Ireland, but also those firms that have been writing business from the UK into the rest of the EU.
I appreciate that, but what I'm trying to get a sense of is that because they're doing this to be able to continue to operate. So it's the impact of Brexit and whether firms are deciding to leave London or Britain and locate here and have this as their European headquarters, as opposed to just rearranging their structure so that they can continue to sell.
It's an interesting issue. So let's be clear, is that it is not, I mean, the EU 27, and in terms of also the regulation community, it's crystal clear. These just they cannot be post boxes or just front ends for the London operation to meet some legal requirements. It would be a dereliction of our duty to the European citizens to say, well, the real power is in London and this is just a kind of local shop or something. So what's been interesting is it does mean there's going to be significant, substantial jobs here, because the responsibility will be here. It's not we can't have a situation where in a firm where the answer is going to be, hold on, I need to phone phone London. So it is a rupture. It's a rupture with the UK in that sense. They have to be self-contained firms satisfying EU27 customers. Of course, there'll be linkages. In a global firm, they'll have American operations, London operations, but the substantial message here is they are sufficiently standalone that we can be effective supervisors, and Europe can say we have sufficient oversight and regulation that we can satisfy what you would expect from a regulator.
Maybe I'm not framing. I appreciate that, and that's to be welcomed, obviously. But maybe I'm not framing the question right. What I'm trying to get at is how many applications are before the central bank for firms which were previously located in Britain, which they were operating as their European headquarters, or maybe they were indigenous to Britain, but that they were accessing Europe, who are now applying here to operate from Ireland as their European base. Have we got a sense of that? Because there was an expectation, I would say maybe at the start, that we could have seen a significant number of firms that would have located here and using Ireland as their headquartered European base.
Sorry, it all depends on the classification of significant. But to my mind, there's been a significant inflow of firms that are the majority of which, certainly from a substance perspective, are focused on EU international activity and have set up European, effectively EU27 headquarters in Ireland. There are some other firms that are of significant size. I referenced insurance earlier, that have located in Ireland to serve the Irish market, maybe as well as the European market, where they've had substance here before. And then there are also a reasonably large number of pretty small firms that aren't going to have any kind of impact on a kind of wider economic perspective, that it may be doing either.
But what is true, though, is in London, you could refer that's a headquarters, but also within that headquarters entity is doing a lot of activity. Whereas you may have firms that are headquartered here or elsewhere, but in turn recognising the nature of the EU27 may in turn have a branch or a subsidiary elsewhere in the EU27. So not all the activity is going to be here. Even if the headquarters is here, they may locate activity across the EU27.
I appreciate that. Just on a couple of other quick issues. The issue in terms of, and I was in correspondence with yourself in relation to this here, this is in relation to the sale of permanent TSB's loans to Glenbeigh Securities. I must say I'm dealing with a number of people who are deeply frustrated, and it didn't make sense to me. These are individuals who want to pay their full mortgages, who were in a restructured arrangement and wants to go back to paying their full mortgages, wants to come out of arrears immediately, and permanent TSB won't allow them. Now that's just mind-boggling to me. Permanent TSB tell them that they have to wait for, to the end of the 6 months period, and they have to deal with Pepper. And you know, and the answer that you gave me when I asked, you said, look, the FOQs on the website of Permanent TSB says that you can pay off your loan at any time, but that's clear in the entire loan. This is somebody who's in a restructured arrangement who may be paying 70% of their mortgage, who wants to make full repayments, wants to get back out of arrears as quickly as possible.
I appreciate that distinction, but maybe...
So we're very clearly of the view that someone should be able to pay more if they want to, as part of the approach. So we've been really clear in our own mind on that obviously your arrangement you can keep and it should travel with you. But if a customer's circumstances are such that they ask for a review and the view is that they want to pay more and they're able to pay more, they should be allowed to do so. So if, could you please give me that information?
I'll ask the individual to, there's emails back and forward where they're being prevented from doing so, and they have to wait to the point.
That makes no sense to me at all. And
I thought so, as well. In relation to just on the transfer of mortgages, and we discussed the vultures, and we'll discuss it again next week when we're dealing with the legislation. But what is your view? Because this Governor, maybe your last time before the committee. So just your own personal view in relation to loan sales to debt charities as opposed to vultures. So what's your view or the central bank's view in relation to these charities entering the market and not for profit and buying loans from commercial banks here and restructuring the loans?
Sure. I mean, so I would, if you have, obviously to set up a charity, it involves a lot of altruistic work to, committed individuals or groups to come up with a non-governmental organisation approach. So if they're capable of with the financial resources to do so, if they, I think that's. I mean, all housing systems around the world will have some mix of commercial activity and then whether it's housing associations or not-for-profits. So if they, subject to the qualifier that they, this is not a kind of that they are able to do so without requiring a discount from the seller. I mean, they should be. I mean, because remember the back.
Every vulture gets a big discount from the seller.
Exactly. So in the sense of, I mean, it's no different. So I wouldn't say. So I don't think there's any. We would have no problem with that.
Okay. Just the final issue I want to revisit is the prevailing rate, which a number of speakers has. But before that, just in relation to our own situation here and the issue in terms of tax, I would have raised the issue before. For example, Glen-based securities aren't going to be paying any tax. Many of these vultures aren't. We see issues in terms of the fund industry and Section 110s, and we've dealt with a lot of that. The European Parliament has just voted by quite a significant majority to declare Ireland as a tax haven. This would be the first time we're now in a list of 5 other member states deemed as a tax haven by the European Parliament. I know you'll be taking on a European role in a number of weeks, but what is your view in relation to the significance of member states coming to that conclusion today?
I mean, it's clear. We can come back to the particular issue about the taxation of different types of funds, which I think is a particular issue. But the broader point, clearly, of Ireland's tax arrangements being brought into question at a European level, and even yesterday and at the IMF, Christine Lagarde made a speech last night about we need, because a lot of this, as I'm sure you've heard many times, is a global issue. So one dimension is taxes not being available to developing countries. Another issue is within the set of advanced economies, what is a fair and sustainable way to tax corporations so that they can't just, through legal structures, end up not paying enough tax. So I think Ireland has to be part of that. But I would agree with the basic point here is that there is an OECD framework, and let's see what comes out of that, because I think it's nearing reaching some conclusions. Because just looking, and as you know, last year with the digital tax debate in the EU, in the end it didn't conclude because of the fact this is a global issue. So I do think Ireland has to be part of that global, and that partly reflects the changing nature of world business. And in my own academic research, which is I've maintained to a degree, the increasing role of multinational firms in the global financial system. You have these superstar firms making huge amounts of profit. That is a global issue about how to tax them. If I come back to funds, I mean, there are some interesting issues. I think we're going to publish some more work, by the way, fairly soon on this.
On the taxation end of it?
Yeah, because of the issue, which is there are always multiple ways to take money out of a situation. Because if the parent firm makes a loan, and then there's not much profit because the interest payments on the loan essentially de facto take the money out. That the issue about debt versus equity, what's taxable and so on, we're working on. And of course, as you know, the tax interacts with the price paid. So if upfront a fund believes it's going to pay no tax on a portfolio, it'll pay a higher price than if it knows the tax rate is going to be something different. So it's factored into the original purchase price what the tax regime is going to be. Of course, the Oireachtas can change the tax law, and it has. So that original expectation may differ over time. But I would say there's a difference between...
Will that report be looking at the property, like we seen yesterday, you know, the bill to rent, and we've got the biggest landlord in the state purchasing up this and pricing, because they're paying very little tax, and the effective tax rate that they pay is very little because of external investors and how they are taxed. So will it look at the property sector and how it's
focus is exactly
the market?
I mean, it's a particular issue about debt versus equity and the tax changes here, but okay. there is a report coming. I would say that there's always going to be a distinction between corporations and then legal, financial engineering issues about, and it comes back to what is a fund and so on. So there's a whole set of issues there, but there is a global context here, and what's going to be interesting is there's increasing resolve globally to move away from where we are now. I think that's true.
Well, we've seen a bit of resolve in Europe, where they've increasing resolve to name us for the first time as a tax haven. Like it's a global issue, but there's many of our partners in Europe that aren't on that list, unfortunately. And my concern here is that we know that certain member states have a certain agenda in terms of tax sovereignty and tax harmonisation, but these type of headlines do nothing for our case in terms of trying to resist that, because there are real issues here that need to be tidied up. And when we have this type of headlines that will make, you know, across Europe about Ireland now deemed a tax haven by Europe, it doesn't assist us in trying to ensure that harmonisation of corporation tax or other matters are resisted.
So, I'm
sorry, I'll go on to the last thing. If I can, and
yeah,
maybe
sure.
just finally, very finally, the prevailing rate issue. This has been discussed more so in Deputy McGrath in quite some detail, discussed it at last year's meeting as well. I must say, Governor, you're coming to the end of your term. This is the sting in the tail. I genuinely believe the central bank has got this way wrong. I can't, for the life of me, understand how you have allowed the banks to engineer a rate that didn't exist, when, if there is ambiguity in the contract, and you have both Ms. Rowland, Mr. Lane, Mr. Sibley have all mentioned about ambiguity in the contract. If there's ambiguity in the contract, what the law states is you have to go in favour of the borrower. That's very, very clear. And for the central bank to say that the then prevailing rate is a rate that didn't exist because the product wasn't there is completely and utterly, I think, will not stand a legal challenge, and this will be challenged in court. I note the report that the central bank gave this committee, where you said that this issue was tested legally by yourselves. I understand, I may be wrong, that it wasn't a unanimous view, that there wasn't a case here that could be presented. I may be mistaken in that, but that is my understanding. But to leave these 6,000 customers having to go through an appeals process, or some of them that won't bother going through an appeals process. Like, when we go back to this, and Ms. Rowland, you talked about the central bank's track record. So let me say this: the central bank's track record in the latter number of years has been good, bar a number of wee issues, and this one being one. But the central bank were asleep at the wheel for a long time before that. You know, we're talking about a huge amount of money that's been taken from people, and this is your role as consumer protection. Now, when you go back to one of the key moments in this here, which was the Thomas case, heard by Justice Hogan, and the defence that was put up by Permanent TSB at that time was that they broke the contract. he was very, very clear in his deliberations and his findings, and he made it clear that if a key clause of this kind is to bear the sophisticated construction, it behoves the bank to spell this out in plain language for the benefits of the customer. Now, these contracts, which we all have, the AIB provided us, this committee, with the contracts, they're standard contracts, they are ambiguous. They talk about a prevailing rate that doesn't exist. They outline the rate in Part 1, and then 3.6, I know you're familiar with all of this, 3.61b outlines that the rate is set, the tracker rate is set in Part 1 of the thing. Like, if it's at the least ambiguous, so therefore they have failed to outline clearly in their own mind, which is what they're trying to do now, that what that really means is that we will apply a rate that is applicable to the market conditions at the time. But that's not what's in the contract. The contract says the then prevailing rate, and the next clause, or the couple of clauses after that, stipulates that the rate is set out in Part 1, and Part 1 has the rate in it. So, based on legal, and I'll finish on this here, but based on legal premises, you have got this wrong. If there's ambiguity in the contract, and there is clearly ambiguity in this contract, then it is not the bank that gets the benefit of that ambiguity. It never is. That's, you know, Ms. Rowland will know this better than me. Never is. It has to be the borrower. And where I believe that the central bank is really failing these customers is you should have took this case. You should have took this case. It's not right for individuals who will take this case, and I hope they win the case. I'm quite confident that I know that there's been a lot of legal opinion being sought from very eminent people in relation to this here, that it shouldn't be them. And this talks about the elephant in the room. Consumer protection under the central bank. Because I've listened to you, Governor Lane, and I respect you. I respect the job that you do. But from Boxer Moran's bill, no good. No consent, no sale to the vultures, no good. Michael McGrath's bill about capping interest rates, no good. When we the regulation of the funds, again critical of it. 4 pieces of legislation, one of them that's already in law, that have one that's been coming from the government, one that's coming from myself, all about consumer protection, and the central bank stands 4 square against it and stands in the corner of the banks and the vultures. And this is the biggest contradiction that we have here, that the central bank has a dual role of protecting the interests of the banks and supposedly at the same time protecting the interests of the public. And that's best shown in the 10 years of the tracker mortgage scandal.
Okay, so let me respond at 2 levels. One is the particular issue about the prevailing rate, and then I'll come to the wider issue about the mandate. On the particular issue of prevailing rate, I mean, just think about why we're here. We absolutely know that we have 2 mandates, and they are not ranked. The consumer protection mandate is as important as the financial stability mandate. I can assure you that the decision we took on the prevailing rate had no factor whatsoever of financial stability in that how that decision was made. It was entirely on what we believed we could stand over in relation to, as Derval said earlier on, could we challenge the interpretation we had on what that meant. So it is not the case that it was driven by any other concern. It was exclusively, and we, in addition to the consumer protection people, this is a whole bank initiative. And let me come back to the fact we have an excellent internal team of lawyers who are there to work out what can we do, what can we do within the legal framework we have. And all of that put together, and the reason, I mean, especially, this has been such a body of work, especially driven by the people on the front line of consumer protection, who are absolutely, the only reason why they work for the Central Bank is to protect consumers. And they've such a dedicated team that we have done everything within the legal limits we see. Now, as you say, this could well come up in a courtroom, and let's see what happens. But we took the belief that that this could not go further than where it went. And which maybe goes back to whether, what that famous phrase meant. Let me stop on that one. Let me come to the wider issue. And this is an ongoing, because we've had this conversation repeatedly. I'm absolutely clear that however much you may disagree and criticise us in terms of our consumer protection work, there's no doubt in my mind that consumer protection would be less if it's run by a different agency. Because when we, and maybe where we have difference of views, is when we think about consumer protection, it's not just the particular individual in trouble on a particular mortgage. We have to think about, well, all the consumers who are paying high interest rates on their mortgage, all of the consumers in the future who may be looking for loans. So if in other words, you offer some immediate, some of the legislation, let's say it did benefit some particular group of individuals, that has to be assessed compared to the fact that if it leads to higher costs elsewhere, if it leads to the risk of the financial system going into distress. Because actually, when the new central bank law in 2010 came in, the first wave of comments, I went back and I read the Oireachtas debates. It was very interesting that there was, I think, a repeated commentary about consumers are not protected if there's financial instability. So we do put a lot of emphasis, broadly speaking, and in relation to these particular pieces of legislation, there is not really, in the end of the day, a tension between consumer protection and financial stability, because an unstable financial system does not protect consumers. And that's really, I think, maybe the perspective we would have. And a separate consumer protection agency, we don't think would deliver in the same way we can as a central bank.
Deputy McGrath.
Yeah, I'll be brief. You should have taken that break when the chair offered it a while ago. I admire your endurance. Thanks. I'll be brief. Just 2 quick points. One is just on the Brexit-related inflow into financial services, and you've been very consistent in saying you don't want brass plate operations, that when people move their HQ to Ireland or move their prudential regulation here, that you want substantive operations to be moved. So are you satisfied in that respect that when it comes to at CEO level, Chief Financial Officer level, functions like risk and compliance, public policy functions, government relations, etc., that those are coming as well? So where a HQ moves or prudential regulation moves, are you satisfied that those tiers are all coming as well?
I'll turn to Ed in a second, but broadly speaking, that's, I think, has been a big success of our robust approach, that we have insisted that these are firms of substance, and that, because remember, we have a fitness and probity regime. So when someone is put forward for a senior role, we have to make that assessment. I mean, are they capable, without turning to other parts of the firm for guidance, are they capable of being standalone, fulfilling those functions? So my view is yes, but Ed's been more in the front line of this.
I mean, the short answer is yes. So in any of the authorisation activity for any firm that is in any way significant, we've had a high degree of engagement before a draft application comes in, review of the draft application, and then a review of the final application. And that has made sure that we understand the type of business that's coming, the proposal around how that business is going to be run, and then enable us to make sure that the controls, the governance, the risk management is commensurate with the risks inherent in the business. And that has involved, in I think virtually every case, that the initial proposal wasn't sufficient for our purposes, to our minds, and that they have been required to put more people in key positions to locate the key management in Ireland, at least on a kind of substantially enough to run the business from Ireland, consistent with it being an EU.
So you're satisfied that that's happening at the level of CEO, CFO, Chief Risk Officer, compliance, and then public policy, government relations?
So I'm in a broad sweep of sweep, yes. There are circumstances where there may be a firm that, say, has a CEO here, has a substantial operation in, say, another jurisdiction that has a CRO in that operation and a deputy CRO here. So in the round, the EU entity is intact and substantial.
Okay, finally, Chair, was the Rebuilding Ireland home loan scheme raised? Or can I just raise that finally, Governor, with you? You're familiar with the background, the fact that the scheme is in the news recently because of the money has essentially dried up, in that I think just under 600 loans have been drawn down under the scheme, and a further 1,000 or so mortgages have been approved. So the initial tranche of money was €200 million. That has now been accounted for and more. And the Department of Housing is requesting an additional €600 million of a sanction. So 200 million this year, 200 million next year, and 200 million the following year. So my understanding is you're being consulted. The Central Bank is being consulted from a financial stability point of view, from the point of view of macroprudential rules. So what is the Central Bank's position on the possible expansion of that scheme, which, to the surprise of some, has been popular? It's not a surprise to me that there would be a lot of demand for that scheme.
Sure, of course. So this is really, I mean, when we look at this, and we have looked at this, let me make a few points. One is, I mean, I think that ultimately it's for the Oireachtas to decide, is this the best use of that 600 million? So we don't comment on that. That's up to you to decide, because it is 600 million being raised by the government.
Housing Finance Agency.
And the very low, because it's government finance, low cost of funding.
Yeah.
So at the level of 600 million and so on, it is a small part of the overall mortgage market. So we don't have concerns about financial stability. But of course, it raises questions about, but it's more of a political judgment about the questions you want to answer, because these are people who've been turned away by the banks, and they're receiving these cheaper, more favourable mortgages. I mean, we think the risk of default will be higher given that. On the other hand, they are receiving cheaper mortgages, which are locked in for the full duration of the mortgage. So those who have access, they are benefiting. It is a beneficial product. Of course, the issue is, how big should that programme be? Because if it gets too big, then any losses that might be incurred in the future, if there's a downturn, will be a loss to the state. But when it's at the level of 600 million, it's not big enough to be a macro-relevant programme. So I'm not concerned about the programme as it is from a macro financial stability point of view. I think the judgments are political about, is that the best use of the funding compared to all other uses of that funding? And then the issues about fairness, about who gets to access cheap mortgages, sure, cheap long-term mortgages.
So are you saying that on the proposal that's on the table, that the scheme would go from €200 million to €800 million, that the Central Bank does not have concerns, is not going to be raising objections? Is that what you're saying?
Correct, because it's not a big enough number to be a financially destabilising number.
Okay. And have you been written to by the department? Have you been asked for your opinions?
Yes, we've written back. But that gives you the gist of what we said. I mean, yeah, so I think you've written to me as well.
I wrote you as well.
So I think we'll respond, yeah. So.
Thank you.
Thanks, Stephanie. Just want to put on record, your meeting with the EBS tied agent. And just two questions arising from that. They made some allegations of criminality, I think, at that meeting. I'm just wondering, what's the process from there? Do you pass on that information to the Minister of Finance or to the guards? Or
okay, I think
I met with the representatives, or certainly some of the representatives. I know there's a separate court case involving different tied agents. They made some allegations around pressurised selling, which we have looked into, and I responded to your letter from December. They also, I think, wrote to you and us and the Minister of Finance in January, again would test to me about these allegations. We can see from the work, so again, slightly limited in what I can say, but I'm being as expansive as I possibly can be, looking at what's been alleged, the type of product that was being distributed through the EBS tied agents in terms of investment products, the risks associated with it, the controls that are in place both from an EBS perspective but also from the provider, which was Irish Life, the level of complaints that we've seen come through, and any evidence of detriment, that we don't see that there has been mis-selling. What we can see is that clearly there were cultural issues there and there's pressure on selling, but I don't see evidence of detriment or of actual mis-selling in terms of those investment products, which are Irish Life investment products.
So their complaints rest with you, they don't go any further.
So we've certainly, the information that we've received, and we're always happy to receive more, if there is anything else, we have looked into, and we recognise there is an ongoing court case. We'll continue to monitor that. We recognise there is a commercial dispute, and there are a couple of other issues that they raised which we responded to directly. But in terms of our work into this, we are satisfied that...
Let me just...
But the allegations of criminality...
Just in support of Ed, we worked on this together, and if we saw no evidence of criminality, but if we did, we take our duties to report very seriously, and we would do so.
Okay. And in the context of the minutes of that meeting, they wrote back to you and asked you to confirm if their record of the meeting was accurate. So they had a meeting with you on the 31st of October, I think. And then they wrote to you in relation to their version of the minute, which they asked for your opinion on, and didn't get a response.
So
you might just have a look at that.
I can look at. We have responded to them, not on the version of minutes. They sent a version and then withdrew it effectively. But I'll check back. If I need to close it out with them, I will.
And the last question, not on that, another matter. The UK's Financial Reporting Council made the following comment in terms of calculating solvency. The fourth directive does require that assets be valued on a prudent basis, but this does not explicitly state that assets such as bank loans cannot be shown at above their recoverable amount, or that all future expected losses should be recognised. Now you're familiar with that commentary. Does the central bank agree with that approach? Is that something that's part of the industry?
So I mean, I think for European Bank, it would be EBA. I mean,
yes.
So Ed's our reps from EBA, so maybe in terms. Well, let's do.
So it's the UK approach you've outlined.
Financial Reporting Council, yeah.
Yes, the banks are required to comply with financial reporting standards, internationally recognised financial reporting standards across all their financial reporting. So not specific UK, but internationally recognised IFRS reporting standards. So we would expect them to comply with that. But that's
so
a matter for the...
It's at that level that they comply. Like there's a European level of reporting standard, and the banks are required to comply with that.
So the banks are required to comply with international accounting standards.
Yeah.
They are also required to comply with regulatory standards in terms of how they report to the regulator. There is a large amount of consistency between the two, but there are some differences between them. But if you want, if you have specific questions on this, or you want to get into it, maybe we could follow up on it.
Rather than take them now, I'll send them on to you.
Yeah, perfect. Thank you.
That might be the best way to do it. Sorry, Senator.
Just to ask your opinion in terms of the insurance companies. As you leave, I suppose, are you satisfied that enough has been done by the insurance companies themselves to reverse the upward trends in insurance costs? I'm just mindful of what your predecessor said at the time that he came in about the low interest rate environment having challenged the Irish industry over the past 5 years. That was in 2015. And as a result, a number of non-life insurance companies took an optimistic view of the economic outlook. And then he talked about imprudent pricing, the underwriting approach and all that. So do you see that over the course of your time that has changed and that the insurance companies are now doing enough? Because that was a fairly stark analysis.
So clearly there's been a lot of supervisory emphasis to make sure that they are operating in a prudentially sound manner, which includes, as you say, taking a realistic view of the prices required to cover incoming claims. So, I mean, I think this is will be an ongoing area of focus. Insurance is a pan-European market, but the kind of prudential approach to insurance supervision, I think, is going to be very important. But of course, I think it's only a minor part of the fundamental issues here about the high cost of insurance, which a lot relate to volume of claims, the legal system, and all the work that the different parts of the system are doing. And as I say, the fact that we are not the prudential supervisor of many firms who operate here. We supervise the brokers, we have conduct of business, but the prudential decision, so the risk of underpricing of price wars could be there in the future because of pricing by foreign firms active here.
Yeah. I mean, this is a topic in its own right that we could usefully spend some time with you on, and I'd certainly be very happy to come back to do so if you wish. There's a lot of work that's been done both by ourselves, but including in the cost of insurance working group, to really get at the cost of insurance in Ireland. There's been analysis done in terms of comparing claims in Ireland. I'm sure you're aware of this. Claims environment in Ireland, the claims environment in other jurisdictions, cost of claims, soft tissue issue, and the like. There are recommendations that have recently come out about trying to put more certainty into the claims environment, more consistency in terms of judicial awards.
I suppose specifically, and I understand all of that in the wider context. I know we have a very short space of time, but at the time, Mr. Honohan said that there's been instances where the central bank had been given false or misleading information, but by regulated entities or by individuals in regulated entities, often in the form of information that's designed to cover serious shortcomings or inadequacy. And what I'm trying to get at, has that happened, say, Governor Lane, in your period of time in office, where false or misleading information has been given? Do you think it's stopped now?
So I think that time period was quite different to the time period we've seen more recently. Under the central bank bill that's in the works, I think there's going to be, similar in spirit to the what Deputy Doherty's put forward. I think there will be a reinforcement of the adverse consequences of delivering false and misleading information. I think that's important.
Okay, right. Thank you.
Thank you. Tell me this, has the EBS a separate licence from AIB?
It does currently, yes.
It does?
Yeah, it's part of the AIB group, but it has a separate licence. It's licensed separately?
Yeah. Yeah, that's okay. Well, that brings us to the end of our meeting, and thanks very much. Sorry.
It is going to be my final appearance. Let me express my appreciation of the work you do. I mean, it's globally, central banks do a lot of work. They have a big impact on many people. So the accountability, and you are the primary way we're held accountable. So I do appreciate the care and attention you've put into these hearings. And I think, even though at the time, of course, we have to work hard to make sure we're ready for them, it's essential. So we do appreciate the work you're doing.
Well, thanks very much, Governor Lane and your colleagues. Thanks for coming, and best of luck. Meeting is now adjourned, 2nd of April.